All right, guys. Where to start with this whole thing? I think it's very fitting to have Ray Dalio's quote up here. Every game has its principles that successful players master to achieve winning results. And I think trading's no different. You need to understand what are the principles that govern the game we play. Learn how to bend those principles. Learn how to interpret yourself within those principles and ultimately achieve winning results. So the crux of what we're going to do today, I think Alex sort of nailed it on the head, which is that I'm not going to give you the Holy Grail today. That doesn't exist. Okay? I'm going to give you a set of governing principles. I'm going to teach you the principles that underlie the footprint. It underlies everything in the market space. If you can learn to apply yourselves to those principles, you will find what you're looking for. Okay? And I don't say success or results or consistency, because what you are looking for in this job depends on who you're asking. Okay, so let's get straight into it. Now, I always like starting every sort of workshop or course or whatever with an objective. What do I want to achieve? Because that way you guys can relate to me. You can understand why is it that he's standing in front here telling us these objectives. Okay, there's a reason I'm here. Okay, and that's to teach you guys about a tool that not many people know about. All right, so if you can walk away with just one of these four things today, that means I've been successful in giving you this workshop. Okay, so the first is objectivity. Right? If you can walk out of here at the end of the day with a mindset of, how do I know I'm right? How do I know this trade's right? How do I know the approach or the process I'm taking is right? Then I've been successful in some shape or form. Okay? If you can walk out, you're having a better understanding of risk management, okay, which is something that most traders struggle with, right? Then I've been successful. In other words, where am I wrong? When am I wrong and where am I wrong? Okay, it's one of the biggest things traders struggle with. Leverage. Right? If you can understand the concept, the basic premise of what leverage actually is, not what the spread bettors tell you and what the fancy brokerages tell you, right? You don't need to be right in this job. You just need to be right at the right time, right? And do it with leverage. And the last one is the information spectrum. And we're going to talk a little bit about this later on, but what is the ultimate price of information? Again, something that's a misconception, right? As traders, one of the things we don't realize as speculators is that price, in essence, should always be correctly priced. Okay? If all the information in the market is accurate, price shouldn't actually go up and down. Now, if we know that, then how can we throw ourselves into sort of this idea that we have information that other people don't? How can we be so strong in our view that it should go up because OPEC cut oil supply? Right? So when you start thinking that way around, you're going to start to realize what information actually is. All right, so those are my objectives. If you can come to me one by one and then go, bang, from Monday on I'm going to be more objective, or I finally understand what risk management always, leverage, wow, I didn't know that, or even information spectrum. If one of those four things you understand better at the end of today, I'll be happy. Okay, if you walk out of here at 10 o'clock and you tell me, I finally understand risk management, awesome. Okay, so with that in mind, today is about you guys, okay? It's not about me. It's most important. What's going on here? Amadeo, we've lost some slides. Do you want to have a look at that, Sonal? Okay, so today is very much about you guys. The more you can interact with me, right, the more I can explain to you. This is not about me going on a presentation going, it's this, this, and this, and this, you do that. That's not a workshop. Okay? A workshop is, I don't understand this. Can you explain this? Right? That way you guys are learning. Okay? This is not me trying to teach you guys that the footprint is the way to trade. Right? It's about you going, I understand this tool. I want to learn more about it. Please explain this. Okay, with that in mind, who has got footprint experience? Show of hands. Okay, so are we talking courses, YouTube videos? Are we?
Use it.
Okay, use it. So
through CEO charts.
Okay, cool. Yeah.
Price ladder jigsaw.
Okay. Who has no experience of the footprint and wants to learn a new tool today? Okay, good. Now.
Quick question.
Yeah.
should you go with market delta? Are they all very much the same?
We'll get to that point over the course of the day. Okay, the important thing to understand, guys, is that if you, just open it on the Google Slides. I'm going to do this in such a way, we've got 3 2-hour sessions. I'm going to start off the first session by explaining the tool to you. Not explaining what the X's in the middle mean. I'm going to explain to you why the tool's powerful. Okay, I'm going to give you the advantages and the negatives to it. I'm going to show you why you want to set it up in certain ways and not other ways. Okay, that way you can make the choice for yourself. This is not about me convincing you. Okay, I use the footprint. I don't need to convince you to use it. I'm just going to show you the power behind the footprint. Okay, so let's go straight to my career. Right, one of the most important things I find traders tend to struggle with is that we're very afraid to be honest. Okay, and that's what this is about. This is not about me telling you about how great my career has been, how successful it's been. It's not about that. Okay, because I'm not successful until the point that I achieve what I ultimately want to achieve. All right, so my career started in 2011. I started as a grad. I began mentoring people simply because I needed to pay the rent. Okay, I arrived from South Africa. I had literally, I think, £3,500 in my name. I was a broker originally in South Africa. Paid a lot of money as a 26-year-old. We have a word in South Africa called windgat. Okay, it's like someone that's just very confident, not arrogant, but overly confident. So I came here thinking I knew everything. I came here thinking I'm going to be a millionaire star trader in a year. Came crushing down, went begging for money from the firm I worked for. Said to them, look, I want to stay, I want to learn to trade, but I need you guys to give me some money. Okay? The agreement was to talk to people, to engage with people, to show people things. Now, the reason I like mentoring and why I've continued it, i.e. doing workshops, is that today gives me a chance to reflect. Okay, today gives me a chance to look inside my own understanding, my own knowledge of the tool, and start to see where my gaps are. Okay, it gives me a chance to engage with you where someone says, what does this mean? And I go, do you know what? Actually, I've never thought about that. And I make a note. That's why I've got the pad there. Okay, so I'm learning at the same time as you are learning. All right, so that's when my career started, 2011. And ever since then, it's been going from strength to strength. Okay, that's pretty much what I'm going to say about it. Now, the dip in my career. Again, I got to that point. I'd made £100,000 in 3 years. And I was going to make $1 million. It was 2015 December. And I was going to start my own team in South Africa, in Cape Town. I had this mansion pictured with a jacuzzi and pretty ladies delivering lunch and everything that you sort of look at as the lifestyle of a trader. And my routine slipped. Okay, I started coming to work at 9:30. I had a different setup. I was going out, having dinners at night time, doing all sorts of fun things. And the next thing, it was ECB December the 15th or the 14th, and it was a Thursday afternoon, beautiful sunny day in Cape Town. And the announcement came down on the Bloomberg Reuters. It was expected the ECB would cut interest rates, and the announcement came down, ECB doesn't cut interest rates. Okay, so obviously you can imagine the market's entirely, completely mispriced. And I had at that point 50 euro dollar FX, okay, as well as a number of bunds, and I went all in, as you do. Just this is it. This is my career. I'm going to make whatever I'm going to make today. Next thing you know, markets white box down whatever number of points because it was wrong. Okay, Bloomberg and Reuters have both misreported it, and yeah, I mean, you go from up there thinking you know it all, thinking you've reached that point in your career where nothing can touch you. One headline from a Bloomberg or Reuters, inaccurate, and that starts the dip in your career. Okay, now if you've read the Jesse Livermore and the Ray Dalios, and you've read every, Paul Tudor Jones, you've read their books, their blogs, you'll know every single one of them has had that. Okay, if you've not had a dip in your career, you're not learning. Okay, you're not failing enough. So the dip is part of the process of growing. Okay, you're only going to learn when you take that dip. Right? I remember that man Alex there. You'll remember the conversation. I sat on the floor, just lying on the floor, thinking it's done. My career's finished. And we spoke, I think, for an hour and 20 minutes. And I wanted to cry, but I couldn't cry because what's the point of crying? I was just shell shocked. I didn't think these things happen, not to me. But yes, that began the phase of rebuilding. Now, make no mistake, it wasn't me coming back a week later and my career started again. It didn't work like that. Right? I literally spent the next 3 months, fighting with people, going, well, how can you tell me I only get £500 risk a day? How can I trade with a one lot? Okay, so unfortunately, this job is all about being honest with yourself. And that's the biggest, if there's one thing I can give you to take away today, stop lying to yourself. Stop thinking you're something you're not. Stop thinking you know everything. Start being honest. Look at the facts. Okay, the facts, the wonderful thing about a fact is it's always truth. Okay, Ray Dalio talks about his principles as the underlying truths. Everything that is a truth governs his decision making. Why are we any different? Okay, he's the most successful hedge fund manager in the world. Why don't we just adopt his principles, his understanding? Okay, so that to give you that story is important for you guys to understand, that I'm just like all of you, right? You're all going to go through this phase in your career. Some of you have possibly gone through it. Okay, so my greatest achievement as a trader, through blowing up and taking that dip, I've spent probably the last 2.5 years learning to listen to people like you, learning to listen to people I hold in high regard. And by learning to listen, i.e. the questions you ask, i.e. you guys tell me about a good book to read, by learning to listen, okay, I can improve my own understanding. So again, I'm going to challenge you guys today to go and determine what is your greatest achievement. Okay, a lot of people go, yeah, cool, I doubled my account this year, or I went from a 5 lot to a 6 lot or a 7 lot. Now, those are good achievements, but what's your greatest achievement? What's the thing that makes you so much better of a person? Okay, for me, is my ability to learn to listen. Okay, and then the last thing, my motivation. I'm not driven by money. Some people are. Some people are driven by fame and fortune and glamour and glitz. I think for me, it's about personal growth. Okay, I want to know that I'm better today than I was yesterday. Right? If you've ever worked alongside me, my biggest, again, conversations with Alex, I've obviously had him as a mentor for years. I've always been very frustrated by a lack of progress. Okay, so I like to progress, I like to improve, 2019, I know what I'm going to do. Okay, if I don't achieve X, Y, and Z, then I'm not moving forward. Okay, so that's me, guys. That's me in a nutshell. Right? I hope you can relate to me today. I hope you can learn from me. I'm not someone that's achieved everything I want to in my career. I don't know everything. Okay, I've got a couple of very good answers. I've got a couple of years of experience. Okay, with that in mind, we can move on to the footprint tool. Ultimately, we don't need to go through this, but to say thank you very much, obviously, to let's go back. Just to say thank you very much to Axia, guys. Without them, we wouldn't have been able to have this venue, we wouldn't have been able to run this workshop, okay? So it's a massive thank you to them, and that's brilliant of them to organize this. Okay, so the index slide, we've got 3 sessions, okay? Session number 1 is going to be focused primarily on the tool, setting up the tool. Ask the questions you want to ask as I go along, okay? Just, again, this is not a classroom, don't put your hand up, just engage with me, that's the point of it, right? So session number 2, we're going to talk about those principles, okay? We're going to start on the principles in the first session, but what I want you guys to understand is that the principles that govern the footprint are the same principles that govern the financial markets, right? They're one and the same things. Do not think of the footprint tool as a speciality tool, okay? I'm going to show you how it fits into the tool spectrum in a minute. And then session number 3, practical. Okay, I'm going to share a video with you guys in session number 3 that is, for most of you, it'll be eye-opening. Okay, for most of you, it's going to be like, wow, I didn't know that was possible, right? When I saw it, and this is someone that's seen some big traders in my career, when I saw it, I was kind of like, wow, this is special. This is history in the making. And I'm going to show you the history in the making a little bit later on. Okay, session number 1, let's get straight into it then. It's going to be about 2 hours long, by the way. So if you need the bathroom, if you're hungry, if you're thirsty, just go. Okay, this is for you guys. So session number 1, we're going to start off with a footprint tool overview. We're then going to move on how to set it up, how to set up that tool in a meaningful way. We're then going to move on to the buying and selling principles. Right? I have given in every session time for Q&A. Right? So you will see there's always time for you to engage with me in the Q&A sessions. Okay, so let's get into it then. And where I'm going to start is how how every great sort of writer always starts. They always give you the answer. They give you the ending. All right, and that's where I'm going to start. I'm going to start with a conclusion and hopefully work my way back throughout the entire day. So ultimately where the footprint kind of lands in this entire thing, all right, is as a trader, this is what we see, okay? We see the financial markets, we see price movement, right? Now it's up to us to decipher where is that price likely to go next, okay? That's our objective. Now, it can go one of two ways, and that's going back. It can go one of two ways, okay? The first is, and what we're using as the example of a breakout. Now, the first way it can go ultimately is where we enter the breakout, price responds, and we make money. And it seems easy, it feels nice, it feels like, wow, I understood that breakout and I made good money. Next time I'm going to do a bigger size, and we move on from there, right? But sometimes it doesn't do that. Sometimes it goes the other way, and we're kind of like, well, okay, yeah, I didn't get it right this time. It wasn't the one. I stopped out, I managed my risk. And most of us stop there, including myself. Okay? Most of us just stop there. We kind of just see it for what it is. Right? We don't do that next step, which is the question of why. Okay? Why did the market, in this instance, continue and in this instance reverse? What was the underlying principle that made it do this and that? Now, when you start to dig deeper and start to ask the right questions, and you'll hear me use that phrase a lot today, learn to ask the market the right questions. Okay, and there's a way to ask the market the right questions, and I'll show you that a little bit later on. Right? But the answer lies in ultimately the interaction. Okay? The reason sometimes the market continues and the reason the market doesn't continue has got to do with interaction. Why? It's not the candles or the charts or even the footprint that make the market go up and down. It's a buyer and a seller. Never forget that. The basic principle number one of a market is that there's a buyer and a seller. A buyer makes prices go up so long as no one sells it to him. Okay? And likewise, obviously, with a seller. And that's in ultimate what we're going to get to. I'm going to take you ultimately today, I'm going to get you to move from this point to this point and finally start to understand why things are the way they are. That's the conclusion of today. And it's got to do with that interaction. And that's where the footprint takes trading to the next level. It's teaching you about that interaction. It's showing you what is a buyer doing, what is a seller doing. Okay? Ultimately, depending on what that buyer is doing and seller is doing, what's the next likely price movement? What's the highest probability? Okay. Now, so this, okay, history of the tool. So you heard Alex talk about he doesn't know when it started. Most people don't, and I don't blame them. Simply because it's actually been around since 2002. All right, I didn't know that until I researched it. But where the concept came from, all right, think of a floor, a big pit, a whole bunch of traders shouting at each other. Now, what used to happen, volumes, actual traded volumes, okay, buyer bought 1,000 used to come out on a squawk on the floor, right, and that's how people heard. Someone bought 1,097. That's how they knew what the actual volume traded was. From that point, the concept was born. Okay, if we don't have a squawk telling us those volumes being traded, right, we can actually get an algorithm or computer to tell those volumes. Right. It was eventually adopted by professionals in 2012. Right? That's when I pretty much first heard about this tool. Now, I'm going to tell you straight up, I didn't want to use this tool. It was forced on us. Right? It was actually not even forced. The footprint wasn't forced onto us. Market delta charts were forced onto us. Okay? We didn't like market delta charts. We went from CKG's platform to market delta simply because the price was about 4 times cheaper. Okay, so that's the truth of where the footprint came from. No one used footprints. Right? It was just another bit of noise, just like a moving average, or it was just all a whole bunch of tools. So it was something that looked pretty colorful, but no one wanted to adopt it. Someone then made the statement, and I distinctly remember it. Someone made the statement, oh, there are net sellers in the market, the position is short. And I remember hearing that, and I remember kind of thinking about it. I wrote it down in my debrief, and someone said the price continued lower that day. That's probably why I wrote it down. But someone said the net positioning was short. And I thought to myself, well, how do you know that? He said, well, look at the footprint. There's a negative delta. And I was like, what's a negative delta? And he showed me, well, prices went down and the delta was building and accumulating. And I was like, I don't know what you're talking about. It's all nonsense. But then he said it again the next day and price responded. And I was kind of like, well, hang on a sec. This guy's actually making money. Let me, as any trader does, he's making money. maybe he's found the Holy Grail. Okay, so this became the Holy Grail for me. It became, as a young trader, I would take anything. Okay, and you'll hear me talk about someone a little bit later on, that special trader. He was someone I looked up to because I literally grew up, sort of as the little baby, he was the father. All right, and it was the same. Yeah, I was very lucky at the start of my career, guys. I had traders, that could make £1 million a day. I've even got a photo. I should have brought it, but I've even got a photo of the original company I worked with where we were allowed to look at the risk screen. Well, we weren't allowed to, but we did. And I remember one distinct day. Okay, it was when the market's on close. You guys might have all heard of the month end. Okay, you'll sometimes hear people tweeting about it. But the month end's back in the day in 2013. The company I worked at, that's pretty much how we survived. Right? There was a going joke on the floor. We would rock up on month end morning, and we would joke with each other saying, guys, today ultimately is going to depend on whether we can take a draw tomorrow or not. Right? And that's how it was. We lived from month end to take draws. And yes, it was a joke, but it was the trade that made the firm an incredibly large amount of money. Okay, but anyways, back to the picture I took. So this day was actually the company's biggest ever up day. I don't know if you were there. No, I don't think you were there. But anyways, it was a month end, and I just remember looking on the risk screen, and there were two guys. It was £780,000 each that they were up. There were two of them on the screen, and then there was like a couple of 40s, 80s, 100. And when I saw that, I was kind of like, what's going on here? Okay. But when you see those kinds of things as a young trader, you recognize that there are certain elements within the markets where we can capitalize on. And that's exactly how I got to the footprint. I looked at it and I was like, this guy's making money. I'm going to make money. And that's where I started with the footprint. Okay, so very much there's pretty limited learning material about the footprint for good reason. Right? There's not many experts. Okay, now in my opinion, there's no experts. Experts don't exist, because when you're an expert, it means you know everything. Okay, and hopefully we all agree that we don't know everything. We actually know very little. Okay, so there's no experts, but there's some good material out there, all right? Now, in a nutshell, if someone asked me, what is the footprint? I summarize it as the following. It's the actual interaction at each price. It's a buyer interacting with a seller. Sometimes they're going to interact aggressively, sometimes passively. Sometimes it's going to look crazy. And it's that interaction in which you can develop pattern recognition. And I'm going to show you again how to do that today. Now, why this is important, a lot of you use the footprint maybe exclusively as a trade to develop strategies. Okay, a lot of you are swing traders, a lot of you trade different time frames. Right? The important thing to understand is that the interaction will always be the same. It doesn't matter what the time is. Right? A buyer will interact with a buyer on a 60-minute chart, on a daily chart. They will always interact. Right? You just need to learn what that interaction looks like and what you want to see in order to execute. Okay. Now, go that way. Now, you would have heard Alex talking about not really knowing where it all fits into the spectrum. Some people are footprint traders, some people trade the price ladder, some people trade, traditional trading tools. Now, the way I like to look at the footprint in terms of the history of trading tools is a bit like technology, right? Back in the day, an IBM computer with a limited processing speed, okay, was pretty good at data storage and running a few numbers. But if you took the same kind of information today and you put it into that IBM computer, right, it's going to have limited ability. We can all agree with that. So tools in the modern era evolve. They become more efficient, they become better. It's the same with trading. It's no different in trading. We sometimes look as traders, I can tell you right now, come to my office on Monday and ask me to change my trading platform or my charting platform, and I'll tell you to get out the door. Okay? Because we don't like change. Right? But when we can actually adopt change, we can take the information. Remember, a tool is nothing more than sorting of information. Right? When we adopt the change, right, we can sort that information better, more efficiently. Right? And that's the point of the footprint. The footprint is one of the newest tools alongside things like the book map, alongside something like the price ladder. Right? The price ladder, the depth of the market, only became available to the retail market, not to the professional market, to the retail market now in the last 2-3 years. Right? It's been available for professional traders for a long time. Right? When I first started trading, if you got a TT license, this pen doesn't like me. When I got a TT license, Amadeo, you want to have a crack there? I'll just rub it. Okay, so when I got a TT license back in the day, it was $1,200 a month. Right, just to put into perspective, that was 2011, 2012, 2013. They cut their prices in 2014 simply because the other charting platforms cut theirs. Right, but nowadays, just one second, nowadays you can get a TT platform, trade depth of market, for free almost. Okay, maybe you pay a couple of commissions to your broker, but in essence it's free.
Can I ask a quick question?
Yeah.
As you're on that.
Yeah.
Does it matter what price ladder you're subscribing to, so
Okay.
to speak? In other words, TT. I've
Yep.
got one with the broker I use,
Yep.
which isn't TT, obviously.
Mm-hmm. Yeah, the simple way to answer your question is it all depends. Okay, if it's a bit like a toolbox. Okay? A couple of us have got toolboxes here. If you're going to do heavy duty work, you won't see a handyman walking around with a cheap set of tools. Okay, because he needs to do heavy duty work. He doesn't have to replace his tools every now and again. It's the same with trading. Okay, if you're going to be doing a specific kind of trading, i.e. maybe speed's important to you, i.e. maybe having loads of screens and screen capacity is important, then you need to spend more money, okay, because it's part of your job. You need to invest in it. It's part of, the job you do. If you are just someone that does, say, for instance, swing trading, right, then having maybe a cheaper platform, thank you, maybe having a cheaper platform is fine. Okay, so hopefully that answers your question. It all depends.
Yeah,
right? And it comes down to, you're all going to ask me, what software can you use for footprints? Now, I'm going to tell you, I have a limited understanding of how many different software providers there are. As far as I understand, there's Market Delta, okay, i.e. CQG. There's then Ninja Trading as well as Sierra Charts. Now, they all have slightly different settings. They all have slightly different algorithms that ultimately dictate what the footprint looks like, right? So it all depends. If you invest and you spend more on something that's quality, i.e. CQG, Market Delta, you have got, peace of mind that it's accurate. And that's the important thing. But it's not to say you need to go out here and spend $1,000 a month on software, right? You've got to determine what's best based on what your strategy is. Okay, that's what it comes down to. Everything I'm going to show you today comes down to what are you trying to achieve? What is your strategy? Okay, yeah.
So software is one thing, but the data feed.
Mm-hmm.
So I've heard, obviously, CQG is one of the best.
Mm-hmm.
Would you say, so a lot of us, I assume, are a retail
Mm-hmm.
trader, right? So what we're going to do is basically use the broker data feed as the main data feed.
Yep.
So would you say that CQG, for example, is good enough to provide an accurate picture of the footprint?
I think, in my personal opinion, yes, I think CQG is good enough. Okay, but what I would also say is, in my opinion, I've got such limited understanding of what's good data, what isn't.
Okay.
So I'm not going to pretend I know the right answer to your question. In my experience, I've always been happy with the data coming from CQG. And that's why when someone asks, what do you use or what can you recommend? I say, well, CQG. I'm not going to tell you I think Sierra is good or not. I don't know. I don't know if their data is accurate. I've never gone and researched it, and I don't intend on researching it. Okay, so let's come back to this. Leading, lagging. Right, I want to put this into the spectrum. So a lot of you trade, i.e., traditional tools, candlesticks, moving averages, all this kind of stuff. A lot of you use market profiles. Some use price ladder, some use bookmap. Right? The important thing to understand is where this tool fits in. It's not to say suddenly I'm saying get rid of your candlesticks. Don't. Right? They all fit in together. But what is important to understand is where each one of these tools lies on the information spectrum. Okay? Some information is lagging, some is leading. And it's important to note that, because the newer information is to the market, the more influence it has in price. We're going to talk about this relationship later. Okay? What you need to understand, when information is fresh, the opportunity that exists has a higher probability of outcomes than when information is no longer fresh. Okay, so in general, we will use these tools, the market profile, the candlesticks, for structure, for understanding, for interpretation. Right? We're going to use these tools for execution. Right? In other words, bang, we're looking for this breakout. We've got this really important level here. Everyone's talking about, even the guy on Bloomberg's talking about the 2600 level. Okay? Now all of a sudden, we don't just use our candlestick and say, okay, well, when the 1 minute goes below this, we're going to sell. Why? Because there's so many false signals that can be delivered on lagging tools. What cannot be false, and this is the crux of the footprint, what cannot be false is if a seller comes into the market and starts hitting 1,000 lots into every single bid and will not stop selling. That cannot be false. Why? Because the underlying market principle is that buyers and sellers determine price. Right? And that's why it's important to understand this, because traditionally what we did as traders was we just went and we looked at a market profile and we saw a bit of structure and we said, okay, I'm going to be long. I'm going to play for the break of this, ledge or something like that. But the problem with that is that you can't play for the break of a ledge until someone is willing to buy for the break of that ledge. And that's very, very important to understand. Old Ray Dalio was always very, very, if you've read his book, he very often talks about this concept of he was the best at knowing where price was going to go. Okay, he was better than anyone else knowing where price was going to go. He developed the models better than anyone else. But he always says he was pretty rubbish at determining the timing. Okay, and that's the crux of this. This is about determining where price should go. And this is about working on that timing. Now, the price ladder is important, bookmap data is important. The only problems or the disadvantages, not problems, disadvantages with regards to these, sorry, it's starting to look untidy, is they're a little bit too fast. Okay, most of you use the ladder, you'll recognize there's lots of spoofing going on, bids and offers being pulled. Now, to the human eye, unfortunately, you cannot decipher what's right and wrong because it's changing too quickly. Right? And that's why, for me, right in the middle, the footprint sits. Okay, because the footprint removes potentially what is being bought and sold, and it only tells me what's actual. And that's why I like the footprint. I love a tool that tells me the facts. Okay, and that's what the footprint does. It tells you factually someone sold 1,000. No questions about it. Not he wanted to sell 1,000, so he put an offer and then he sold. No, it tells you exactly how much was bought and sold. And that's why I like the tool.
Much easier to read than time and sales?
Much easier and much quicker to read. Okay, why? Because time and sales doesn't put the information. Time and sales is just data, it's information. The footprint actually sorts that information. Okay, structures it. Now, let's move on. Okay, not there yet. I will get the hang of these in a minute, guys, don't worry. Okay, now we're going to go through the advantages and disadvantages. Right? And again, this is not me to convince you. This is just how I understand the tool. So the first one is to funnel noise, okay, into information. In other words, we all look at data. Okay, and this is the problem probably a lot of you have. You've got lots of little things on your charts. Moving averages and volume indicators and all these sorts of things. Now, what's wonderful about the footprint is it takes all of that information, everything that's going on in the marketplace, that is important. Okay, the only thing at the end of the day that matters is how much am I willing to buy and how much is willing to be sold. Right? Actually bought and sold. Now, with the footprint, it's going to funnel that into what we call the funnel effect, which is it takes all this information, okay, and steadily, yeah, we'll get there, guys. Yeah, it funnels all that information bit by bit by bit, and it spits out an answer. Now, this is the way you got to look at the footprint. You want to set your footprints, and I'm going to talk a lot about this today. You want to set the footprint up in such a way that it tells you an answer. Okay, you don't go look at the footprint and go, okay, let me try and understand the market now with the footprint, and I'm looking and I'm, no. The footprint is there to tell you, okay, there's a buyer in the market. All right, I did my analysis and I know there's support here in the oil market. The footprint's telling me there's a buyer, therefore what do? I buy it. I'm not looking to understand, what's going on with all this information. I'm just looking to make a decision utilizing the footprint tool. Now, it allows you to extract all of the information into one graphic. And I think this is where the footprint is extremely different. Okay, it takes price, time, actual volume, relative market changes, interaction between buyers and sellers. It takes all this information and puts in one graphic. Now that's very different to most other tools, because most other tools you need to keep adding things like volume. Okay, so you have traditional candlesticks, you need to add the volume on. You need to add the relative changes on. You need to add, all sorts of other things just to get the same picture as you would get with a footprint. Right? So again, for me, it's a much better depiction of what's going on. It replaces the reliance conundrum. All right? Now, the reliance conundrum is something hopefully most of you make the mistake, which is, okay, I've got this line here on this candlestick chart, and I'm going to buy it there because the candlestick shows a line there. Okay, we call this the reliance conundrum. Why? Because we rely on the tools to make a decision. Right? If you are trading based on the tools, you're making a mistake, because it's not the tool that makes price go up and down. It's the buyers and sellers that make price go up and down. And that's where it replaces this conundrum, because you're no longer reliant on the tool to make a decision. You're reliant on the buyers and the sellers. Okay. It moves the subjectiveness out of it, and this is extremely important. Like I said to you with a price ladder, bids and offers being pulled. Like I said to you, is this support, isn't it support? Well, that's all subjective. Right? The moment you actually have physical volume involved, i.e. someone bought it and he bought the next price and he bought the next price, we don't need to argue about what happened there. Okay, we can simply see it. Someone bought every single price. Therefore, there's a buyer. Therefore, we have support. All right. Leading information rather than lagging information. I've explained that. It can be used as a standalone tool. And I will talk about this and show you this a little bit later. But the footprint can be used as a standalone tool. In other words, you don't need other tools, i.e. candlesticks and all that. Or it can be used in conjunction. And I'll show you the conjunction platform next. Relative indicator. And this must be highlighted. Okay, this is probably hands down the single most important thing that comes from the footprint. It shows you relative changes. Okay, it shows you nuance shifts. It shows you anything you need to know in the market on a relative perspective. What do I mean by that? Right? If you have buyers and sellers in the market doing absolutely nothing, okay, in other words, we just got algorithms playing around with each other. Traditionally, what we would do is we would see something like this on the volume. Okay, I need to just hold it down, don't I? Okay, so traditionally we would see the volume do this, and the minute it broke out, we would see the volume pick up. Okay, so that's, I'm just going to stay on here for now. That's what we would typically see on just a traditional chart. Now, where the footprint takes this a step better is it's going to show you not just the volume change, but it's going to show you the interaction change. Okay, you're going to see the buyers and sellers changing the way they're interacting. Now, yes, in the first bit, we've got algorithms interacting with each other, so it's low volume, not much delta going on. But when that interaction shift comes in, when that relative shift comes in, you're going to see it far more nuanced, far more precise on the footprint. Okay, and that's kind of why this tool is significantly better than traditional tools. Okay, and then the last advantage is a tool to perfect market timing. Again, a lot of you are very good in your analysis. You're very good in your technical analysis. You're very good at, you're very good at working out which way price should go. What you're not very good at is that thing, the market timing. Okay, and that's fine. You don't have to be good at it. You work on it. You improve on it. Right? Every single day in a debrief, you take the trades, you look at the trades, you look at where you executed based on what you executed, and you'll improve that timing. Right? And then the last thing is risk management. Right? Now, most of you, I would like to think, are leveraged traders. Right? Now, the footprint tool is extremely good for risk management simply because you will learn to decipher where a trade has become invalidated. Again, I will show you this, but the basic crux of it. Right? The footprint tool is going to give you signals. Now, if any of you have ever done the footprint course, you'll see everything gets dealt with. Every strategy has got a signal. For example, if you've taken the free segments of the footprint course, if this is a resistance line and we're looking for a breakout, the moment we get a nuance shift, i.e. we look and we see a change in the interaction, whether the volume's picking up or whether the buyers are absorbing higher prices, right? That nuance signal shift gives us the signal to execute. Right? We simply then execute the trade looking for the break. Where does our stop go? It goes below the signal. Okay, and that's the real key, is that we're moving away from this idea of signals where if candle 1 crosses over candle 2, you buy, those kinds of signals. And we're moving to a signal where if a buyer starts to increase the amount he's buying, starts to absorb more liquidity from the sellers and the volume picks up, we use that actual signal, the actual interaction as our signal, right? And we simply just stopping out below that signal. Right? Can you see the power of that? I mean, what it makes now suddenly is it gives you very easy risk management. Right? You move away from this, I have to put my stop all the way down here because candle 30-minute has a swing low here. Right? And that's why this is a perfect tool for particularly leverage trading. Now, it's not to say the footprint tool doesn't have disadvantages, because it does. Okay? And those disadvantages are very simple. You have to set it up correctly. If you go away today and you suddenly put a footprint tool up and you think, I've got the Holy Grail finally, this webinar was so good, I'm literally going to make money from Monday. What you are doing is you're inviting noise. Right? The moment you put something in front of you, think of your screens. Okay? The moment we put anything in front of us, what have we got? We just got noise. All of this is noise unless, like I said with the funnel, unless it's taking all the information and giving us the ability to make a decision. That's how you have to look at every tool, whether it's the footprint, the candlestick. Set it up in such a way that you can simply switch on, you look at it, you go, there's a seller there, I'm short. That's how you have to set up the tool. And I'm going to show you ways to set it up, but ultimately it's going to take you time to, number one, understand what approach do you want to take? What strategy are you looking to execute? Okay, and you're going to hear me say this a few times today. There are a number of different strategies I can show every single one of you today. I could show you 10 different strategies today if I wanted to, right? But the important thing to understand is you only need one strategy. Please, I'm going to hammer this point home, particularly in the last session. You do not need to be a jack of all. You just need to be a master of one. If you want to make money in this job, there's an end bit where I'm going to show you 7 things I wish I knew when I started. Okay, there's 7 lessons. If you can take one of them away, you're on the right track. Okay, but one of those lessons was stop trying to be good at everything. You don't need too many strategies. You need one. One is the only number of strategies you need. Trust me, guys. Okay, but what you do need to do is become the master of that approach. Okay, so set it up correctly. That's the crux of it. And the second one is time must be spent. Okay, it comes without saying. You've got to spend time. You're not going to become good at the footprint tool in a week, in a month, in 3 months. Okay, like I said, there's no experts. I've been using this tool for 4.5 years, and guess what? Every time I look at a footprint, I'm learning something new. Every single day, I'm learning something new. Right, so you've got to take that approach of, I've got a good tool here. This tool gives me the ability to make better decisions. Right? I want to adopt this tool because I agree with the principles it teaches, because I agree with how it takes information and gives me a final definitive answer. Okay? And then you have to keep developing it. All right. So yes, it does have disadvantages. Now, let's move on to something a little more exciting. Now again, I know a lot of you probably, a lot of this is probably you understand, but we've got to go through it. It's important we go through it. But equally, just remember, like I said in the beginning, the way I explain something to you, you might actually pick up on something. I might spark a thought in you. Write that thought down, okay? Don't let anything go unquestioned today. If there's something that you want to look into deeper, maybe an interpretation, an understanding, a principle, write it down. I urge you, reflect, think. Okay, the minute you start to think is the moment you're going to start to realize that this little game is binary. Can never forget that. When I have my toughest days, the first thing I write in my journal, which is this little pretty book here, which has got all these notes, the first thing I write is, it's a binary outcome. The price can only go up and down. It can't do anything else but go up and down. Now, if it's a binary outcome, we make it complicated. The minute we start putting information and listening to blogs and using Twitter and all of these things, the minute we start inviting that information, we're complicating a binary outcome. Okay, never forget that as a principal truth. Just like a buyer makes the price go up, a seller makes it go down, the binary outcome is that price can only go up and down. Okay, now I'm going to explain the power of the footprint by comparing it to a candlestick. This is what we would typically have seen in the 1970s, 80s when candlesticks came about, right? Someone recognized that having information with a high and low price didn't make sense, okay? The low was 84, the high was double O's, right? That didn't make sense to people anymore. Why? Because they wanted to trade multiple markets, multiple time frames. So suddenly someone became clever and they said, well, let's summarize that data. And they created a picture called a candlestick, and then there was breakthrough. Okay, it suddenly allowed people to start to see large amounts of data into a funnel. Good morning, welcome. Okay, so ultimately, all that's happened now is that, like I said to you in the beginning, we've advanced. The world's advancing. We're creating a new tool now that's taking the same information the candlesticks have, except it's adding in the one vital element, which is what the heck is going on inside that candle. Okay, now the reason we want to interpret what's going on inside that candle is because we want to make decisions as to what's going to happen to price next. What's the next likely movement? Now surely you can see that if we just utilize this, which again most of us do, okay, most of us just utilize the traditional candlesticks. By just looking at it like that, we're missing out on quite possibly the most important information. Right? So when you look at it like this, you start to see, okay, well, yeah, no, having that additional information can definitely add value. Now remember what I said to you in the beginning. Just looking at it like that, going 103 by 83, no, that just looks like a lot of noise. Okay, warranted. If someone said to me, that looks like a lot of noise, I'd say, yeah, it looks like a lot of noise to me too. But what happens if I told you that whenever you see 5 green in a row, right, that means there's significant buy pressure, and the probability of price going in that direction is 65%. Can we all agree that suddenly you've got something that's quite powerful? Is there anyone that disagrees with that statement? Anyone? Okay, so what have I done there? I've taken a tool and I've created a set of rules. Okay, I've then gone and tested those rules. Well, if there's 5 green, the price 65% chance is going to go up.
Based on your data set, your back period, you can only declare 65% based on a data set.
Yes, 100%. So you need to do a little bit of work, okay? But I've defined a set of rules, and the set of rules have told me the probability, if I've got 5 greens, is go up. Suddenly now, the information that I can extract from this candlestick starts to add value. Now the mistake a lot of us will make is we'll then go, okay, well every time I see now 5 greens in a row, I'm just going to buy it and it's going to go up. That's the mistake we're going to make. But there's another step, okay? And another step is, if there are 5 greens, number one, how can I take that 65% to 75%? Is it maybe entering on that price? Is it maybe exiting on that price, taking smaller winners, taking bigger winners? Is it maybe using heavy size early and small size later? Okay? And that's how we have to approach this. We approach the footprint not by looking at it and going, well, there's 5 greens, price might go up. We look at the footprint and say, well, there's 5 greens. This is the trade strategy. It's a buy here, it's a sell there. The stop goes below the 5 greens. End of discussion. Okay? The moment you can start to look at the markets as just simple strategy, simple binary, simple, well, I've got to make 10 ticks there. Okay, well, this one's one time framing, so I've got to hold this until a seller comes in. That could be 10 ticks, 20 ticks, 30 ticks, 40 ticks. The minute you start to look at the market as not what or where can this go, what's the potential possibilities, and start to look at it as, well, I know that there's a high probability this is going to give me 8 prices. You're going to start to recognize the most important thing, which is what we're all after, is consistency. Okay, so that's it, guys. That's ultimately what the candlestick is. It breaks open that candle and it shows you what's going on inside. All right.
Sorry, can I ask a question on that slide? Some of your green highlighted numbers seem to be lower than the other ones. Is there any particular reason for that? Or?
Sorry, in this one?
Yeah.
I've literally just taken a picture of images.
So you've got 164, 166, and 164 would indicate a buy.
Yeah. Yeah, again, this is just, I don't even know what this is showing. Don't worry about I just want to illustrate the break open.
Okay.
We'll get to proper candles in a minute. Okay, but just so you all know, high-low, this is called a rotation. Sorry, okay, these are rotations. I'll talk a bit about them later. That's the highest part of the rotation, the lowest. It opens as the low, so you can see it has the same information as a candlestick. Opens, closes at the high, and then yes.
Isn't the green because it is the imbalance?
It could, yeah, that looks like what it is. It looks like there's imbalances in it, I would assume. Again, Google images. Okay, don't worry, they're not all Google images. Most of the images will come from me. Okay, now let's break it open. So this is where I'm going to explain it to you. Again, if there's any questions, by the way, it's important you understand this basic part. Yes?
Are those numbers that you showed
Yeah.
in the breakdown, you would see on a price ladder?
That's,
Are those the
no,
numbers you see exchanged at that price?
no. So on the price ladder, you're going to see bids and offers. Okay,
So
this
those
is,
weren't bids and offers.
those are not bids and offers. That's physically what's traded. Okay, so the price ladder, you'll have a whole bunch of prices, bids and offers. On this, you're effectively seeing what actually traded. How much did the buyers buy and how much did the sellers sell? Okay, so this is taken from my charts. Okay, now what we've got 6 elements that you want to look at. We've got number 1, price change. Number 2, time. Number 3, actual volume. Number 4, delta. 5, cumulative delta, relative change, liquidity, volatility. I'm going to go through them each. Okay, so the price change is in essence each one of these. Okay, every one of these represents a price. Everyone happy with that? Now, at each price, or let's go through time. So each one of these segments, we call this a rotation. Now there's different ways to set up your footprints, and I'll talk about that a little bit in the next section. Okay, but in essence, every one of these sort of bars is a rotation. Okay, now they can be time-based rotations, 5 minutes, 60 minutes. I use daily rotations. Okay, you can also set them up as point and figure rotations. You can set them up as anything you really want them to be, right? But remember what I said to you. This tool is to take information, funnel it to get to an end outcome. Okay.
Can you take time out of it completely?
Yes.
Use it like people use tick charts?
Yes, so you can get a point and figure. So you can see how many prices does it go in a straight line before it actually turns back. Okay, so what a lot of traders used to do when the bunds, okay, so traditionally bond markets sometimes move in basis points. Right? There are algorithms that are created to move a market 1 basis point. Okay, so for example, 1 basis point in the bunds, when these traders did it this way, used to be equivalent to 7 prices. Right, so what they did was they set a footprint up as a point and figure to ultimately show every time the market went up 7 prices in a row. If it had then, say, more than a 3-tick pullback, it would create a new rotation. Right? The purpose of that was, what they did was, I don't know why it's doing this, but anyways. Okay, so the reason they did that was they could then see when there was big order flow coming into the market, big participants coming into the market, right? Because if it cannot even pull back more than 3 or 4 prices, it's showing a lot of price pressure, okay? It's showing that there are big participants looking to move yield. Now again, that might have been the biggest load of baloney ever, who knows, right? But it was a concept, it was an idea, and some of them went that way. Suddenly, they took all this information and started to sort it in terms of rotations. Okay, so there's no right and wrong. For me personally, I've always liked the idea of time. Why? Because it's a consistent over which I can put information into blocks. That's why I like using the element of time in my footprints. It's not to say it's right. Okay, so each one of these is a time-based rotation or a rotation. We then have actual volume. Now, actual volume is what you're seeing here. So for example, I'm going to take this little segment out. We've got 148 multiplied by 121. In other words, okay, and the best way to explain this, is that a seller, let's call this price 10, a seller sold 148 into the bid at price 10. Right, 148 contracts were sold at price 10. At price 10, a buyer bought 110. Now a lot of you are going to go, how can a buyer and a seller sell at the same price? Okay, well it's very simple. Yeah, you have price 9. Don't worry guys, we'll be patient with this. Okay, so yeah we have price 9 and yeah we have price 8. In essence, a buyer was lifting 121 whilst potentially a seller could have sold at 9. Equally, a seller was selling into 10 when potentially he could have obviously, I've got that the wrong way around I think. Okay, other way around. No, I've got that right. See, this is what happens when you don't get coffee in the morning. Okay, so in essence, there we go, that works. You could have had a seller or a buyer lifting 11s or a seller selling 10s. You all got that. Don't be too confused. But in essence, each one of these blocks is showing us the physical transacted volume from buyers and sellers. Now, the total of that, okay, is nothing other than volume. I'm not going to write so much. Okay, so the total of that is effectively the total volume. So we can see 148 and 121, we're looking at 269. So 269 contracts were traded at price 10 within this time frame. Now the difference between the two, 148 and 121 is 27. right? That difference is what we call the delta. It's the net interaction between a buyer and seller. Okay, now the net interaction will tell us a lot about who's in control. It's not that simple. You don't just go look at every price and go, okay, he's in control, he's in control. What we're looking for is significant control shifts. We're looking for very specific patterns that show us that control, and we'll get to that point. Okay?
So where would the delta show on that?
Okay, in terms of, yeah. Okay, so the delta will show in two places. At the bottom is our statistics table. Okay, but the other thing is the color. All right, and this is where the footprint is very unique, is that it not only summarizes information a lot better than most charts, but it actually then takes it a step further and colors it. Okay, now hopefully all of us can have experienced at some point in our lives how easy it is to interpret things with color. Okay, we can adopt, our minds can take on color a lot better than, say, information or numbers and all that. Okay, so we can associate colors with something very specific. Now, the reds indicate more selling pressure than buying pressure. Okay, and the blues indicate more buying pressure than selling pressure. In other words, in this example, we have 148 by 121. There's slightly more selling pressure. Why? Sellers sold more than the buyers bought. Therefore, the color would be red. Now, the different gradients of color is all dependent on that net interaction. In other words, if there's a very big amount of selling relative to buying, it'll be a much darker red. Versus if, for example, only 27 contracts, it'll be a much lighter red. Okay, and that's what the colors are all about. The darkness is showing us how much of a difference there is relative to everything else. Okay, so you can start to see how it's such a strong relative tool, because not only does it show us colors, but also shows us varying degrees of color to show us that net interaction. Okay, so that's the delta, the cumulative delta. Okay, just simply, by the way, with regards to delta, we obviously have a delta within each one of these rotations. We also have a net delta, which is down here. That's that minus 1,853. All that's showing us, it's telling the delta in every one of these prices, and it's putting a total number. Okay, now again, don't be too bogged down by this. It will start to make sense. The cumulative delta is just simply the delta accumulated over a period of a session, or a day, or a couple of days. So all the deltas over a number of days, all that buying and selling pressures added up over a number of days, and it's called the cumulative delta. The relative change have I explained to you, okay? It's the shifts, it's the changes in the interaction, right? We can see up here, for example, there's a lot of buying pressure. Why? Because we can see buyers are lifting 1,600, right? And we can obviously see that the sellers are also selling at the same time, right? Equally, at the bottom, we can see quite a bit of selling here versus the rest of the candle. Okay, so that's what we're looking. We're looking for the relative adjustments, the relative shifts. Now, relative change, you'll see I bring this term in a lot today. It's not just relative change within one rotation, it's relative change across all the rotations. Okay, remember the footprint tool, we're looking for those nuanced shifts, that change in interaction. Now, liquidity is just simply how much volume is being provided at each price. Volatility is the number of prices over which we're trading. And then the net interaction, as I explained, also known as the auction intensity. So it's the net interaction that's occurring at each price. Okay, now these principles, liquidity, volatility, relative change, is pretty much the governing principles of this tool that I'm going to be sort of really hitting home quite aggressively. Okay, now, is everyone happy with that? All right, cool. So I'm going to go through this quickly. I don't want to spend too much time.
Try to use this one.
Okay.
Yeah.
Is it going to be red as well? Cool. Let's try that. Okay, so I'm going to go through this quickly. I'm very aware of time, by the way. Just, again, remember, one of the most important things, this footprint tool is, unfortunately, it would probably take me a week to teach this tool. Okay, if I was to spend 6 hours a day. I've only got 6 hours today, so some of the stuff I'm just going to kind of skip over. Right? If you've got any questions, that's what I'm here for in the breaks, etc., etc. Now, how does it utilize in the trading process? I think I explained this earlier, but we're using the footprint tool to make the decisions. That's ultimately what it's there for, right? The price ladder is for our executions, and the market profiles for our structure. Okay, so we keep our candlesticks, we keep our market profiles. We build the structure, we build the understanding, we develop those patterns that support the resistance. Where is price, the path of least resistance? We use ultimately the footprint to give us that clue, to tell us, you know what, there's good support in this market, I'm looking to buy, I want to be a buyer today. Bang, the footprint shows me that shift, the buyers have stepped in, what do? I start buying it. That's what the footprint's for. And ultimately the price ladder is for execution. Okay? The reason we use the price ladder as professional traders is because when you're trading even something simple like a 10 lot, right, one price is $100, $100. Okay, you add that up over the course of the year, giving away one tick because you use a different platform, and it adds up to a significant amount of money. Okay. Now, any questions? Anyone want to ask any questions? And yeah? Any questions? Everyone happy so far?
Can we go back to the 5-minute rotation with the net delta and the net interaction? How do you distinguish? Is that the same thing, or
the net delta?
Net delta interaction between the two. You had 2 different points.
Okay. Yeah. So again, the net delta in essence is the interaction summarized on each rotation. Okay. Whereas the price pressure is in essence, you can almost look at it as price is moving, how's that interaction shifting? Okay, if that makes sense. So the one we're looking at almost a summary of the net interaction, whereas the other we want to see at each price, where is that price pressure coming? Is everyone happy with that? Yeah? Okay. Any other questions and answers? Otherwise we're going to move on.
About rotations, is it user defined when a new candle starts painting?
Completely user defined.
Right.
Yeah.
It could be volume based. I'm interested in.
Yeah.
Okay.
Yeah. And I'll show you these settings now. Okay, that's where we're going to move on to now. I'm going to give you some basic ideas of setup, and you can then go from there. So part 2, setting up your footprint tool. Now, a lot of you are going to ask me, how do I do it? Okay, and if you ask me how am I doing it, then you're not taking the crux of this webinar. I'm not here to show you how I do it. I'm here to explain to you why the footprint tool is powerful. It's a tool to sort information. So the way you set up your tool has to be different to the way I set it up, because I'm setting up my tool to show me something for me, for my decision making. You need to set up the tool for your decision making. All right, so software providers, I've mentioned these. Those are the 3 that I know. Okay, I use Market Delta. I get no promotional value out of them. In fact, Market Delta doesn't give anything for free, unfortunately. All right, so I use them because I've always used them since 2012.
Do you use them for your charting as well?
I use them for my charts as well. I've got TT charts as well. I've got Reuters charts. I've got Bloomberg charts. Okay, so again, I use each one of those things for something very specific, not just because I like lots of screens and it looks pretty cool. Okay, now time frames. It's very simple. Okay, you can set your time frames up however you like. You can set it up in a 1 minute. All right, when I'm trading a month ends, for example, I've got 5 minutes in which I want to see the interaction. Now, if I have a 5-minute footprint or an hourly footprint, it's not going to help me. Why? Because I have loads of other information at each price. So I zoom it in all the way to a 1 minute time frame. So I can see specifically every single minute what's going on. Now, hopefully a lot of you can understand when there's volatility in the market and you're trading a month in and you're looking for, say, a 10-handle move in the next 5 minutes, right, that interaction on a 1 minute is more meaningful than it would be on a 5 minute or on a 60 minute. Because it's the same thing. Sometimes you use a 5 minute, sometimes you use 60 minutes, sometimes you even use a daily. Right? When I first started looking at Bitcoin, I used daily footprints only. Why? Because there's so little. I mean, we were trading 450 contracts a day. Why would I look at it on a 5 minute? It makes no sense, adds no value. Okay, so remember the funnel. I wanted to take all the Bitcoin information and all I wanted to see was where are buyers providing liquidity. That was my strategy to Bitcoin. Where's liquidity being provided? The minute I see liquidity being provided, I can lean on that to make buying and selling decisions. That was my strategy, and I set the footprint up that way. Okay, so again, hopefully that answers your question. How do you set up footprint? Well, I set it up based on what I want to see, based on my strategy. Okay, sorry, was there a question there? No? Cool. Okay, so types of rotations. This is what you asked. The first one is time. It speaks for itself. All right. Now, why I like time as well is that you'll see on every one of my footprints, you've got these 2 little green bars. Now, that should be self-explanatory. We opened at the bottom, we closed at that price. It's simply just a candlestick next to it. Right? The reason I've got that is so that I can see the net change in price on each candle. And we'll talk a little bit about this. Footprint on its own, in other words, it's not just about understanding the interaction. Right? If there's a big buyer in the market and he starts buying tremendous amounts and he buys everything he can, but price goes down, that's telling us something. Okay? Equally, If the sellers are coming in and they're selling it and they're smacking into the low, and this is massive area and it's the 2600 in the spoos and the market's volatile and the bears are in and 2600 keeps getting whack, 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 the price doesn't go down, what is that telling us? It's telling us someone else is on the other side taking all of that selling. Right? And that's where the footprint is hands down more powerful, because you cannot see that on a candlestick. You cannot see all that volume, all that selling being absorbed or taken by the buyers. Knowing that information, knowing that you've just seen that, puts you in a far better situation to make a decision of, do I buy, do I sell? Okay? And most important, you're making a decision on the facts, i.e. the sellers are selling, the buyers are absorbing. Okay? You don't need to discuss it, we don't need to have an opinion about it, it's a fact. Okay, now, the second type of rotation I mentioned is point and figure. Okay, so a lot of traders do set up a point and figure. I experimented with point and figure for the equities. I used to use 0.1 increments. Why? I don't know. It sounded pretty cool. Okay, so for the Euro stocks, I think at some point it was 8 ticks. I used to have an 8-tick rotation, and then whenever it went the other way, I'd switch it around. Okay, you could set up your equity markets to 1% changes. Okay, only turn around when there's more or less a 1% change, and you look at it on a long-term perspective. The important thing to understand is it doesn't matter how you set it up, as long as once you've set it up, because that's the information you choose to see to make better decisions, you stick with it. Okay, because every time you change, and we'll talk about this a lot during templating, every time you change, you're going to be asking a different set of questions. Now, how are you going to learn the answers to the questions you're asking if you're asking a different question every time? And that's what templating is. You might have heard me throw that word around a lot. Templating is simply just a series of questions I ask for a number of days so that I can extract the same information, and more often than not I'm going to get the same set of answers, but those answers are going to change sometimes. Okay? The minute I start getting the same answers back, what do I develop? Pattern recognition. Okay. Now, the ways you can set up those little bars, okay, so these little bars, you can set them up in a number of different ways. You can set them up with what we call bid times ask. This is a bid times ask, okay, and in fact, I'm just going to go to the next page because it's there. Okay, no, come back. Okay, so these are the 4 types of ways you can set it up. Now, this is standard across any footprint tool provider. This is the bid times ask. It's simply the sellers sold 33, the buyers bought 13. Bid times ask. Now, if you want to get to the delta, as I explained, the net delta, and you don't want to see the actual volume trade, you just want to see the net interaction, you've got this one. Okay, you can see the 33 and 13 is we've got more sellers hitting in by 20, so we've got a red 20. So it just shows the net interaction. You can take it a step further. If you only want to see the total volume at each price, you can simply just go and change it to volume, right? Then it just takes the 33 and the 13 is 46, which is that one over there.
Brannigan, can
yes.
it be done on, I mean, I've got my ones with Sierra charts.
Mm-hmm.
Can it be done with that, or is that very market delta?
Simple answer is I don't know.
You don't.
You can, yeah.
Okay?
You can.
I would like to think it is because it's a standard setting. Right?
I've got these, but I've confused it. You've made it look a lot simpler underneath.
It's because it is simple. Okay? The important thing to understand is that, again, don't be sucked in, don't be lured into going away going, ooh, I'm going to have one of those, I'm going to have one of those, I'm going to have one of those, I'm going to have one of them, I'm going to have one of each. All from my bund, I'm going to have it on a 1 minute, a 5 minute, a 60 minute, a daily. Guess what? Your decision making is just going to go out, just don't waste your time. Right? Personally, I've used that for 4.5 years. I understand the power of that, make no mistake. I can guarantee you can develop some extremely strong pattern recognition just using that. Just using the volume, just using the imbalances. Okay? The imbalances, I'm just going to touch on that briefly. All an imbalance is showing, and we will talk about this as a trade strategy later. But an imbalance is just showing us where the interaction, morning, no, you're right. The interaction has suddenly become more aggressive. What do we mean by that? Okay? We can see in this little period here, very balanced. Okay? You can see there's roughly the same amount of buying as there is selling interaction. If suddenly that shifts, what we tend to do is we tend to see imbalances. It's where suddenly the buyers come in and they start to lift more aggressively. So they start to take out the offers more aggressively, leaving this form of imbalance, which is how we read it, what they call diagonally. In other words, the buyers come in, they lift aggressive offers, but there's not that much selling coming into the bid. And it starts to leave these little blocks like this. When you see that, they simply just imbalances. It's an imbalance between the auction process. Don't worry if that doesn't make too much sense, we will go over that later. Okay, so that's the 4 ways you can set up your footprint. Now, let's go back to that screen and let's finish off here. Now, the statistics to include. Again, and in fact, if I ask the question, what statistics should we include on our footprint? Anyone want to have a bash?
Whatever suits your needs.
Say that a little louder for me, please.
Whatever suits your needs.
Okay. It depends. You put whatever you want on your chart to make a decision. Hopefully that's the driving point for today. Stop adding things just because you think it's going to add something. If you're adding something, it means you don't know what your process is. Okay, if someone said to me, how do I set up my footprint tool? I'll say it depends on the strategy. Okay, and that's how it should be. You only add something because it adds value to your strategy, not the other way around. You don't go and find a strategy by looking at the chart. You have a strategy, you have an approach, and then you apply and you set up the tools accordingly. Okay, so the statistics that you can include, right? Most of the footprints do have what they call summary statistics. Okay, for instance, it tabulates. It says what's the total amount of volume traded in each rotation, the total delta in each rotation, the cumulative delta in rotation. Okay, the price change. There's a number of different statistics you can include. The reason you add those statistics is for summation. Okay, I don't want to have to go and look at this and go, let me add this up quickly. Let me try and add that up mathematically and see what the total is. Okay, so you add it up so it can do the job for you. That's what the statistics are for. Okay, color lines. Now, if any of you have done the footprint course or even the profiling course, I love colorful lines. Okay, why? Most people just use one color. Now, remember, there's so much information in the markets. You need something quick and handy, something that can, just by the look of it, tell you the answer. Okay, now I use colorful lines based on what I'm trying to interpret. So, for example, if I have a really, really big breakout area, a trader that I'm playing for a breakout, I want to smash into it, I don't go and look, okay, well, there's the oil, there's the euro, there's the pound, okay, this one's approaching the breakout. No, there's too many things going on. Okay, I'm simply observing the markets. I look up, I go, oh, oil's 10 ticks away from that breakout. Why? Because the dark blue line is there. And I take my attention to the oil. Oh, there's an anomaly there called a ledge. It's a green line. Oh, I can see it in the Bund. Oh, wow, okay, cool. Bund's coming to this anomaly. And I take my mind there. Okay, I know what to do with a ledge. I know what to do with a breakout. I simply just execute it based on my strategy. Right? But the colorful lines allow me just to straight away take my attention to where it needs to be. Okay, so I implore you, use different color lines, try it out. Right? These are the color lines I use. Again, I know Alex said no recording, that's cool, but if you want to take a picture of something because you want to maybe consider it, that's fine. Okay, I've got nothing wrong with that, just take a picture with your phone. Right? But those are the colorful lines I use, pink, red, brown, orange. Okay, pink is for weekly levels. Right? So rather than scrolling back going, what's the weekly high and low, it's on my 30-minute chart, I can see it straight away. Okay, it doesn't mean I have a trade there, but I know where the weekly level is just simply by having that color line. Okay, and then the last one, indicators. So what indicators do we add to our footprints? Anyone want to take a guess of that? Anyone?
VWAP, point of control.
Okay, anyone else?
What you need.
There we go, simple answer. Okay, it's not wrong.
No.
I'm guessing you use the VWAP. Perfect. Okay, if you use the VWAP to make a decision, by all means, right? Add the statistics that are going to add value to your decision making. That's how you set up a chart. Okay, so some of the things that I do use, funnily enough, is a moving average. Why? Why do I use a moving average? I don't buy off the line. I don't care what the line is. I just want to see the direction of the moving average. Okay, if a moving average line is sloping upward, it's showing me price pressure to the upside. Does that mean I buy? No. Okay, but if I'm long and I see the buyers enter on the footprint and I see the shape of the moving average moving up, it's just adding that confirmation for me. That's why I use it. I don't use it for anything else. Okay, I don't use crossovers. I don't care about any of that. All I care about is the slope of that moving average.
Which moving average?
The one that adds value. Okay, that's going to be my stock standard answer. It's the one that adds value, right? 5-minute moving averages sometimes add value to my daily candles. Sometimes 20. And then you can ask me EMA, simple, exponential. It depends. What's going to add value to decision making? But again, Don't add things just for the sake of adding it because it adds value. Okay, and then obviously volume profiles, all sorts. Okay, the crux is it's not about what I add. Look through the functionality that you can add. If it adds value to the decision making, add it. Okay, questions and answers. How to set up, anyone, any questions? Excellent. Okay, is everyone doing okay? Everyone good? Yeah, we're getting there. The fun stuff will come, okay? It's boring in the beginning because it has to be. That's like everything in life. You have to get through the boring stuff to get to the sexy stuff.
One question.
Yes.
Is the net difference in each rotation between buys and sellers what you call negative delta and positive
Correct.
delta?
Yes, correct. And again, guys, there's no silly questions, okay? I'm just talking and blabbing on. I might not explain something so well. If you want to know something well, ask the question and I'll explain it. Okay, so yeah, good question. Okay, now we're going to get to these principles, the underlying truths, and I'm going to teach you some truths, facts. We don't need to debate them. They're not up for debate. They're truths about the market, just like a buyer makes the price go up, a seller makes the price go down. Okay, we're going to start off with the auction. I'm going to explain the auction, the concept of an auction, what an auction is, what it should be. Okay, I'm going to talk about overlap of rotations versus one-time framing, liquidity and volatility, intention and price dynamic, initiative, responsive price behavior, relative change, and triggers. Now, like I said to you in the beginning, unfortunately, there's about 101 different principles I can teach you with regards to buying and selling. Okay, this interaction. I can teach you so many different principles. I just got to get a footprint and show them to you. Right? You will develop these principles by reading the story every day. What do I mean by that? Okay, in a debrief, what you're typically looking to do, you're typically looking just to get the footprint up, and you start at the beginning of the day. And you start to read the story like a novel. Right? The market opened. Sellers came in. Was there liquidity? No. Prices dropped off quite quickly. Looked quite volatile. Right? Big price ranges. Prices dropped, but the delta didn't go negative. Okay. What does that tell me about the story? Well, if the delta didn't go negative, but the sellers were selling it, it means that the buyers weren't providing that liquidity. Okay? Because if the buyers were providing liquidity, there would be a negative delta. Okay, so I have a price change of 20. The price is now at the low of the day, but there's no negative delta. Okay, interesting story. The story continues and unfolds even deeper. Suddenly, the volume picks up, the delta becomes very negative, but price doesn't change. Okay, interesting. So now suddenly, I'm seeing negative delta, I'm seeing volume, and I'm seeing sellers sell, but someone's sitting there providing liquidity. Okay, cool, interesting story. Price starts to go a bit up. Okay. Maybe there were buyers there providing liquidity, and the price starts to rise. And it starts to rise quite aggressively. Imbalance, skips over everything, goes right back to the high day. Well, okay. So someone absorbed, took price all the way to the high with no effort because it was quite easy, which means there was no one selling it on the way up. Now you get the idea of it. It's a simple story you're telling yourself in your head. Now, if I come in every day and I read this story, I'm going to start to recognize, oh, okay, wow. So yesterday, and we take the example of the S&P. If you're trading the S&P this whole week, Monday to Thursday, every single morning outside of the cash hours, wow, no offer. Delta wasn't even that positive, and prices just went 20, 30 handles. The big boys come in at 230. Suddenly, they start selling, and there's no one on the bid. And the delta goes negative, and we drop. But we balance. Okay? Monday, Tuesday, Wednesday, Thursday, that was the play. Markets opened. The price response was, overnight, there was no offer, no sellers providing liquidity. Price went up quite easily. In the afternoon, it sold off. Yesterday, however, it changed. Was there a bid up in the morning? No. The sellers came in overnight and they continued in the US session. And that's the story we learn. We learn to read the story with the footprint. When you start reading that story every day, guess what? You're going to become very good at telling that story, very good at understanding that story. Okay? And the most important thing, that's not a story that often on the floor I use the expression of, which is what we call a thumb suck. It's not a thumb suck story. If price goes up 20 handles, but there's no liquidity being provided, that's a fact. We can see there's no liquidity being provided and price is rising. Right? So we just lean on those facts and we read the story based on the facts day in, day out. So that's where we're going to go. That's these principles. It's that interaction, and that's what we're going to spend the next 45 minutes doing. Okay. So I'm going to go through this with explanations, because the best way to explain these things is to literally just draw it. Okay. So the auction. back in the day, you got to cost your mind. The best way to do this is think of yourself in a like a big warehouse, and they're selling cattle. And the farmers all come, they got the cattle on the side, and you got the hungry meat butchers on the other side, and they want some cattle. Okay. Now, how price works and how the markets are created, and again, we're all speculators. I'd like to assume we're all speculators here. Okay, we're all speculating on price direction. The markets weren't created for us. I hate to break it to you. Now, one of the biggest mistakes I see a lot of young traders make, they go, but why would someone buy it here? Okay, that's not how investing works. Investing is typically a neutral hedge or a neutral delta. In other words, investors are not looking to speculate. They're looking to manage risk. Okay, they're looking to put money to work and manage the exposure, manage the risks around that exposure. Right? So what that means is that a lot of the time we might think something is a good buy, right? But it all comes down to what the big time frame players, what the big institutional players think. Right? Now, in the basic premise, again, this is a principle. Okay? The basic premise is that when a price hits a discount price, we should not be seeing sellers entering at a discount price. Okay, why? Because if price is deemed a discount, it means that we should see buyers facilitating trade, i.e. being aggressive. Why? Because it's a discount. And that should make prices rise. Likewise, when we reach a premium, we should not be seeing anyone buying the market. Why? Because prices have now reached an expensive premium price. Now, unfortunately, it doesn't work that way. Okay? Due to emotions, due to what's fair value? Where is the fair price? And this is why I'll say to you a number of times today, stop thinking you know. That is probably the most dangerous thing, and I think Ray Dalio stresses it so much. He kind of says when he started accepting that we actually know nothing at all, that's when you finally begin to know something. Okay, so it's the same thing, yeah. Where is that fair price? Where is that discount, that premium? We don't know. Okay, so rather than us speculating on where that fair price is, we'll just let someone else, the guy at Goldman Sachs, the guy at Citibank, the institutional clients, we'll let them make the decision. We'll let them deem something a premium and a discount, and we'll decipher that using our tools. We'll begin to recognize what it looks like on a footprint when we have something called a V reversal, and that's the strategy I'm going to show you today. Okay, a V reversal shows you this discount and premium. And there's a very specific way in which you can partake in that discount or premium. But the first thing you have to understand is the underlying premise behind an auction, which is what? Okay, when we reach this point of discount, we see a switchover. We see buyers becoming quite aggressive initially. Right, so buyers will be aggressive where price is deemed relative discount. So somewhere in that zone we have a discount. Now, yep.
So how would you define aggressive?
Okay, by price response. And again, I'll show you this in the V reversal. I'll show you in the interaction. That'll probably make sense of it. But it's got to do with the interaction. Okay, and I think the best way to explain this is to look at the concept of liquidity. Okay, we're going to get to when we talk about responsive and initiative type price behavior. In essence, what happens is when we get to a discount, you'll have initiative type price behavior. In fact, let's go through it. So what initiative price behavior is exactly what the word says. It's an initiation. Okay? It's the start of a buying series because prices are discount. Right? Now, when we have one side initiating, one of two things happens. Okay? Price will rise depending on how much liquidity is provided to the market. Okay, that liquidity being provided is what we call responsive price behavior. Why? Because participants respond at higher prices. In other words, what I'm trying to say, there's an initiation that starts here. Goldman Sachs comes in, they start buying up the market. Now, Goldman Sachs will keep buying until the order's filled. They don't have a choice. They need to buy 10,000, they're going to get it done. What happens to price is purely determined by the response of whomever is willing to sell the market. If no one's willing to sell it here, what's price going to do? It's going to keep rising. If no one's going to sell it here, what's going to happen? Price will keep rising. If someone steps in to start selling it here, what's price going to do? It's going to stop rising and it's going to move sideways. Okay? If then the sellers overwhelm the buyers and they're willing to sell more than the buying, prices will start to drop. Conversely, if Goldman Sachs keeps buying and that seller stops, or there's no longer sellers, prices will then continue to rise. Right? And that's the process of initiative. We have the initiation process and we have the responsive process. Okay. Now again, just understand the principle. When I start to talk about liquidity a little bit later on and volatility, this process is all going to start to make a lot of sense to you. Right. Coming back to the auction process. Just remember, we don't know where prices are at premium or discount. Okay, we're not going to even try and figure it out. We're not going to even try and guess where it is. We don't need to guess where it is. Right? What we will learn to do is decipher when something is being deemed a discount and when it's deemed a premium. Okay, and there's a specific way to execute that, to take advantage of that. Now I want to come back to a question, which it's a question that again I see a lot of younger traders making this mistake. Okay, so how many of us think what's a good market to take? I've got to think back. What is a decent market at the moment?
S&P.
Okay, let's go to the S&P. So
The oil market.
the oil market. No, not the oil market. Definitely not the oil market. Okay, so we got the S&P 500. And it's come down to this 2600. Now, how many of us thought 2600 would be a good buy because maybe we're in the sideways structure or who knows what? Does anyone think it was a good buy there? Anyone? Okay, so we have one buy. Anyone think it was a good sell down there?
When?
Just recently, so this last week. Okay, obviously there's a lot of price pressure. This 2600. Okay, again, it's probably bad to use an example because maybe some of you don't trade the E-mini S&P 500, right? The crux of the matter is that coming to this 2600, the mistake a lot of traders make is they're going to go and they're going to say, okay, well, there's the support line here. Now, this line is held, therefore I'm going to start to buy the market. I'm going to provide liquidity to the market. Now remember what I said to you when we came back to this example of initiative and responsive. If we go and put a one lot bid, we want to buy the S&P, there's good support. What are we doing? We are responding to price. Okay, so price has moved and we're responding and we're providing liquidity. That's what we're doing, fact. Okay? Now by providing liquidity to the market, you are making an assumption that someone else is also going to provide liquidity. So just think about that for a second. Really, really think deep about it because it's a mistake I made and I still make time and time in my career. How do we know someone's going to provide liquidity? What, just because there was a line there previously? And that's a really, really deep, sort of meaningful thing to think about because...
Can I ask you something on that?
Yeah.
Right, so this is where possibly with these footprints and maybe open interest, I mean, what could force liquidity is forced buyers or sellers.
Okay.
So with the footprint, does it show? So it shows the transactions with the buyers and sellers, but does it show who's actually holding contracts?
No. No. Again, you could probably go and set your footprints up in such a way to show you where the positioning is taken from. That the footprint's very good at. Okay, the footprint will show you precisely where the sellers are engaging and building that attack effectively, or where they're trying to build that position from. But to then go and say, well, the net positioning is short is completely false because you're making the assumption that people are selling because they want to be short. Okay, you could have people selling because they're getting out of longs. They could be hedging. They could be effectively taking a spread. So how can we suddenly associate with, you get what I'm saying? To make a definitive decision that this positioning, because price has gone down, is inaccurate because you're assuming you know what everyone else is doing and why they're doing it. And that's why we move away from that. And that's kind of why I want to just hammer home this last concept. Why would we provide liquidity with the assumption that someone else is going to provide? It makes no sense. It's like, in essence, you're gambling. That's what you're doing. You're gambling on the potential for someone else to be there. Now, don't get me wrong. Sometimes you take a gamble. Okay, remember that example where I said, if we have 5 green imbalances in a row and we know there's a 65% chance that price will continue to rise, okay, what are we going to do? In this instance, we're not providing liquidity, we're taking liquidity from the market. Why? Because we're going to the market. We're lifting someone off of the offer. Why do we do that? Yes, we're taking an element of a gamble. Why? Because ultimately, we're not 100% sure that someone's going to keep taking liquidity. But we take that gamble because the odds are in our favor. Now, to go at the 2600 and provide liquidity, are the odds in our favor? It depends. It depends. If your strategy is that you want to buy the S&P against, say, spreading the NASDAQ, then fine. Your strategy allows you to be providing liquidity there. That's what it comes down to. I really want to get you guys to start thinking in terms of strategic approach instead of gambling approach. Okay? One of the most important things, and I say this to a lot of people, you know, I had a guy come to the office the other day and we were talking about the property market in London. And I gave him my express views because I have a view and I have an opinion and, you know, I kind of like to be right sometimes. But I finished by saying to him, what does it matter what I think? Prices can keep going up, they can triple, they can quadruple, they can collapse. How do we know? All we know is that the principle, okay, hear me out, the principle is that property prices have risen exponentially over the last 10 years. Now, if we go back in history and look at property markets where they've exponentially risen, and we see what is the potential for further upside, we can make a definitive answer that as prices have exponentially risen, the potential for more exponential rises become probabilistically smaller. And the risk exposure becomes greater. So yes, you could buy property in London and it could go up and you could be extremely successful. Awesome.
Should have bought in Germany. That's gone.
Okay, so again, that's the point to just drive home, all right, with this auction. Get away from assuming buyers and sellers in the market. Get away from this idea of I have to be long because Goldman Sachs says the euro-dollar is a good buy ahead of the Fed interest rate meeting next week. Get away from that approach. It's not going to do you any justice. Start applying yourself. Is there a buyer? Bang, I want to be long. Why? Because the 2600 is a fantastic support. Okay. Had you taken that approach subsequently, actually, if you look at the S&P this week, it broke below the 2600, broke to 2585, I think, low. The whole world was bearish, including me. Okay, the whole world was playing the breakout. Oh, we're going to collapse. It's the end. The S&P is going to collapse. Where did it finish? Well, it ramped back up to 2700. Okay. So who knows? Nobody knows. All we know is that on the break of that S&P, some sellers came in, and I'm going to show you this example. They started hitting that thing damn hard, and they got their just reward. They got the flush out. We got the 35-40 handle move. But then guess what? The selling stopped. And what happened? Someone started absorbing, right? Started to go bid. What did all the sellers do? They started to take profit. It went bid higher and higher and higher. Suddenly we get to 2600. We get some more sellers step in. How do we know? Not because I say, but because the footprint tells you. And the sellers tried to defend it, and guess what? They got overwhelmed the next thing with 2700. And everyone that was short, that had this view of it's the end of the world, got forced out of the market. Everyone that was observant, looking at the interaction, saying, well, hang on a sec, we've broken 2600, we've gone back bid to 2600, there's no one selling it here, there's no one responding to this price, no one's even providing liquidity, and the buyers are just becoming stronger and stronger. The observant ones got the hell out and said, well, let me keep my nose dry on this one. I'll let someone else gamble. Okay, so we've skipped a few slides, but we'll go back. So just an example of the auctions, okay? Rotations. Now we're starting to see a bit of a bigger picture. We've got a couple of rotations. Each one of these are a rotation. Okay, remember these are candle opens, candle closes. Now we're starting to see our statistics on the bottom. All right. Now the important thing, I want to just bring this statistics table in so we can bring that concept of relative change back into it. Okay, what we're looking at in relative change is the change. Okay, in each rotation, what is happening in terms of price, what is happening in terms of the delta, what is happening in terms of the volume. Is there a change? Isn't there a change? How well are the buyers doing? How well are the sellers doing? Okay, so I'm just going to take out a basic example. We can see that volumes go nice and light here. Okay, we can see price rises here and price falls here. The net change on these two rotations is pretty much flat. Right? There's volume, but we can see it's relatively low volume. Why? Light colors. Okay, so not only do the dark and light shades show us the change at each price, but we can also see the change, the relative change, in summary version. Again, it brings back that concept of why it's such a strong graphic representation. Okay, we can see the same thing with the delta. Go back. All right, we can see at the bottom, yeah? Notice the deltas. There we have quite a relative strong amount of net buying. There we have quite a strong amount of net selling. Okay, now each one of these on their own mean absolutely nothing. Okay, if someone said to me, what does it mean that we had a very strong net selling here? It just means there was more sellers than buyers, more willingness to hit into the bid. Okay, you have to find the combination of the relative change in volume, the relative change in delta, and the relative change in price. Okay, you need the combination of the three. It's not one on its own, standalone, it's all three combined. Right? If you can learn to read the story in that way, how is the price changing when there's a big change in the volume and the delta, you're going to start to paint a very pretty picture. Okay, so that's the auction process. Up here we got sellers, up here we got buyers. Okay, now what we're looking for on the footprint when we start to develop strategy, we're not so concerned necessarily with what we call this is potentially noise. We call this noise. Okay, and it's noise simply because the market is not sure which way it wants to go. And we can see that because the first 5 minutes it goes down, and then the next 5 minutes it goes straight up, and then the next goes down, and then up, and then down, and then up. Okay, we call that noise. Now, noise does not mean no opportunity. Right? If you're a flow trader, if you're a momentum trader, and you like momentum, that's noise. If you're someone that wants to be a market maker and you like to scalp around and you like to play little liquidity buckets, which is another footprint strategy, that is opportunity. Right? Opportunity, and this is, I remember when I was growing up as a grad, I always remember when we got taught, the guy used to come up and he always used to say, no, that's wrong. No, that's wrong. Why did you buy it over there? Well, it went up. Okay? There's no wrong or right in trading. Okay, if you think there's a right and wrong, you don't understand trading. Remember that concept of binary? It goes up and it goes down. The minute you invite this concept of wrong, means you shut your mind down slightly further. Okay, markets just simply go up and down. So opportunity exists everywhere. It just depends again on your strategy. And you set up the footprint based on your strategy. If you're someone that likes flow and momentum, you set it up that way. If you're someone that likes to fade a market, you set it up that way. Just because I say you're silly for buying it there because there's a lot of negative sentiment, doesn't mean it's wrong. Example in mind, the S&P ramped this week. And lots of people who were like, you were wrong for buying it there, lost money. Okay, this job doesn't reward right and wrong. It rewards right at the right time and punishes wrong at the wrong time. Okay, how do we know that? Well, again, we look at the facts. Don't listen to me. And I implore all of you, everything I say today, test it. Test the theory. Okay, I'm wrong most of the time. I'm going to be wrong in some of my analysis today as well. Okay, so you need to go and test everything I say and develop your own underlying principles. Okay, because when I apply my principles and my understanding, whether it's wrong or right, I apply it the same way every single time. So I can develop consistency in interpretation. It's the same for you guys. Okay.
Can you tell the difference just looking at the footprints? This is the work of algos and this is the work of actual traders that are taking directional trades.
Yes and no. Okay, the simple answer is it's all got to do with the volume. Okay. The only misleading why I say no is because you can have high volume and can still be algorithms. All right. So rather than get fixated on what's an algorithm, what isn't. Okay, at the end of the day, you've got a bank at Goldman Sachs who executes via an algorithm anyway. So rather than think of algorithm, not algorithm, think in terms of, well, where is their opportunity? What does that opportunity look like? Can I bring that opportunity out time and time and time again? And can I make money out of it? It doesn't matter who's doing it and why. Okay, again, if we move ourselves away from this idea of, I have to buy it because it's because of interest rate policy and blah, blah, blah. If we move that away from that spectrum and start to just look at the markets in terms of probabilities, right, you're going to start to see opportunity rather than it has to go up, it has to go down.
So The reason I ask specifically is because if you take yesterday, for example, in the S&P, there were 3 or 4 times where on a reversal 40 chart, for example, but you could see it on the 5 minutes as well, where so volume expand. So if the previous rotation were like 1,000, 2,000, all of a sudden you have a big rotation that is 18,000. The delta goes with the move. The delta explode, right? So instead of being a couple of hundred, it becomes 3,000, 5,000. So it moved 5, 6, 7, maybe 10 handle. It stopped a little bit, and then it goes all the way back down. So I'm looking at this and I'm thinking, so, you know, footprint is good, volume is good, price is moving in the right direction. So why is it coming all the way back? There's a lot of imbalance, obviously. Why is it moving all the way back down?
Okay.
That's why I'm asking,
okay.
You know, is this algos? Is
yep.
this...
Let's come back to that auction process. Okay. What is the role of an algorithm? Okay, the role of an algorithm is to facilitate trade between buyers and sellers. Okay, our role as speculators is to facilitate trade between a buyer and seller. Now, a buyer and a seller, in essence, are our big institutions, are our big banks, are our big hedges, are people that want to take a position in the market for whatever reason. Okay, so anything in between, we can actually say is algorithmic in nature, or someone that's bringing a market towards the buyers and sellers. Now, on some days, it could be 5 handles. When the volatility is the way it is at the moment, it could be 40 handles. Right? If you look this week, I think we were doing 45, 50 average handle ranges in the S&P, and we had 4 distribution days. Right? So the crux of the matter is, we want to identify where there's significant buying and significant selling, and we can just as well assume that the rest of it is not necessarily algorithmic, but the rest of it is just trade being facilitated. Now, it's your job to go and find a way in which you can facilitate trade in a way in which you can manage the risk and still give yourself potential upside. Okay, so don't be too worried about where do I buy, where do I sell. Just accept the fact that the minute you are stuck anywhere in this 45 handle range, and you're trading anywhere within, say, a 30 handle range, you are playing in the game where trade's being facilitated. We don't know who's facilitating, we don't know why, we don't know what they're doing, we don't need to know what they're doing. All we need to know is how can we partake in that facilitation? When do we need to take liquidity? When do we need to provide liquidity? Okay? And the simple answer is, well, you've got to find the approach where you can apply yourself consistently. Okay, cool.
Is algorithmic trading ever going to be the death of the point-and-click trader? Okay,
the death of the point-and-click trader will never disappear.
Right.
Okay, just for the simple fact, and again, I think Uncle Ray, as we call him, he summarized this quite nicely. Right? They use algorithms not to make the decisions for them, but to, in essence, make a decision. They make a decision, and they compare the decision making. Right? That way, what happens is sometimes the computer's wrong, right? And they can teach the computer a better way of interpreting something. Remember, an algorithm's still designed by us.
Yeah.
Right? Equally, they sometimes get it wrong. Okay, we're just human. We make mistakes. Our decision making goes wrong as well. So that way, you have a computer that makes a decision. Sometimes the computer is going to teach you something, right? So again, algorithms are there to assist us. They're there to aid us. Don't think that algorithms are going to replace us as humans. They're not.
Would I be right in saying one of your elite traders, Demetrius, who you put some videos up of, his style of trading, you just couldn't do on an algorithm, surely?
You're saying you could do?
You couldn't?
No, you could 100%.
You could do it?
100% you could do it on an algorithm.
Really?
Yeah, 100%. Okay, what do you think?
In and out,
So the speed at which the markets move, what do you think creates that speed? It's not normal humans. It's algorithms that are reacting off certain elements that are coming to the market. Right? So again, don't be too bogged down then. If you think algorithms are, what the algorithms have done, and you know, if we're going to get into that discussion, it's very simple. The algorithms have just added a number of more strategies to the market. Okay, if there's one thing that I felt how the markets have evolved over the years, is that I think back in 2011, 2012, right, I used to have a portfolio on my Evernotes of all the economic data that moved markets. Now, if you ask any trader nowadays, does economic data still move markets? There's maybe sometimes inflationary data that moves it, but mostly it's just central bank decisions. Okay, that was, I mean, back in the day, economic data was very much market moving. Less so now, right? Why? Because there's probably a lot more strategies, there's a lot more involvement, there's a lot more people doing lots of different things in the market, right? The most important thing is just to make sure that you evolve in your own approach. You don't have to change, you don't have to develop an algo to be successful, you just have to make sure you evolve in your own approach. Yes, sir?
Just with regards to that question, we were actually joking on the trading floor a couple of days ago that the algorithms are probably saying, man, I wonder when the discretionary trader will die, because we're probably losing so much money now. Because the algorithms, they reach a point of no return where they're fighting against each other for price, and especially on comments, the Brexit comments that's been happening recently, especially on the denial that all of a sudden some algorithm is triggered by some type of volume variable, and then they start eating each other away. And that kind of gives an opportunity for the point-and-click trader. And we have traders on our floor having their best careers now. But you get the old hat trader who hasn't evolved, hasn't developed, who says that the algorithms are destroying our game. And so it depends on you, if you are evolving. The algorithms that stay in the market forever are the ones that are evolving as well. So, and we have one trader in Poland who started programming. He never really watched the market from a discretionary perspective. He watched the markets in the beginning trying to program algorithms. It's the wrong way to go. You first have to understand the markets before you actually program an algorithm. If you don't understand the markets, how are you going to apply some type of algorithmic skill? So the discretionary trader, I mean, we have a floor of very successful traders, and the algorithms, I feel they are starting to struggle against each other, because it's been this race to the bottom of speed and latency, and and the cost of that latency now is becoming a lot significantly higher. Anyway, that's just.
Is the volatility harder for the algorithms? That's been very volatile. It was only moving 10 handles a day, the S&P.
Yes,
so many months ago. Now it's sort of 20 to 40.
I mean, I'll leave it at that.
Yeah.
I can answer your question after.
Okay, so let's move on. We're going to give it another 15, 20 minutes. We're going to take a break, have some cakes, get some sugar. Yeah.
Quick question. What time frame are those candlesticks?
Okay, so everything I show you today, assume it's 5-minute rotations. Okay, I've tried to keep consistency. In terms of the markets, when I feel it's important to show you the market, I will elaborate on it. When not, yeah. So all of it's 5-minute rotations, you can assume that. Okay, so we talk about strong and weak auctions. Okay, very simple. Weak auctioning is simply where a market's just rotating, consolidating. Okay, that's the terms we like to use. So a weak auction is not necessarily weak in any other sense than there's no price strength coming into the market. Okay, versus a strong auction, we can very clearly see there's price direction, there's price strength in this auction. Now, most important, do not think, and this is a mistake I made in my career very early on, just because price is going down and auctioning down doesn't necessarily mean that the market's going short and there's very aggressive sellers coming in. Right? You can have very strong auctions on very low volumes that, guess what, get reversed in a straight line. Right? One of the hardest things I ever, and this is a mistake I used to make, whenever I saw, this is when I first adopted the footprint, whenever I saw these one-time framing, I was so adamant that, well, you have the strong auction, surely you've got sellers entering the market. The first bounce, I'm getting short, and guess what happened? The market would just straight line reverse the other way, and I'd go, how does that make sense? The whole way down there's price pressure, and it's pushing and pushing. It pulls back, gives me a chance to get short, gives everyone else a chance to get short, but it goes straight line the other way. Okay, so at first as a trader, I did the instinctive thing, which is, no, the market's wrong. Okay, it's always the market's fault. But then when I started to look deep into it, I started to go, okay, well, let's actually look at this auction. Let's see how these sellers are actually selling. Well, price is moving quite a lot there. We can see a significant change in prices, lots of zeros, but the volume's pretty darn low. There's no real negative delta there. Okay, which is telling me that very clearly no buyers are providing liquidity to this market. And then it went down again. And you can see a little bit of liquidity there. Not too big, don't worry about the size of it. It says 102 by 150. But price goes again. A little bit of a pickup in delta, which we would expect. Why? Because as price moves, it brings more participants in. Okay, that's another key principle to understand. Price ultimately leads volume or activity. Why? Because when price moves, people respond. Now, when price moves significantly, i.e. volatile or volatility, you'll have even more volume. Why? Because when price moves very aggressively from one point to the other, who's it bringing in that auction process? It's bringing in more of these bigger time frame participants. That's why when there's high volatility, you'll tend to see high volume associated with it. Okay, back to the example. So price kept moving, but what's the volume doing? Surely as price moves lower and lower, we should see volume go higher, because the basic premise, the truth, is that when volume picks up and price starts to move more volatile, more aggressively, we should start to see volume pick up. But actually it's going the other way. So we start to see something called a divergence or an anomaly. And suddenly my head went, okay, so from now on when I see one time framing that's very aggressive, but it's on low volume and these anomalies exist, what I'm not going to do is sell a pullback. In fact, what I am going to do is if I see the buyers come in, I'm going to join the parade. I'm going to hop on. Why? Because what I've observed is when there's a strong auction on high volume, that tends to continue in a trend-like fashion. When there's a strong auction on low volume, that tends to reverse in a strong. Why? I don't know. But it's a pattern I've learned to observe.
Sorry, just in this example,
yep.
Where are you seeing the buyers coming in?
Okay, I haven't got enough of it there, but
right,
you need to look a little further on. Okay, but you understand the premise of it, guys. This is why we move away from this concept of, well, price is going down, therefore it's a sell. And we actually start to say, well, price is going down. How is it going down? Who's making it go down? Why are they making it go down? And I tell myself that pretty little story that I told you in the beginning. And I keep developing that story. And every day I read the story, I tell myself the story, and I start to develop my own understanding of the story. And as I develop the understanding of the story, I get to that point where I can tell you the conclusion of the story before it's actually happened. Okay? At this point, I can already tell you this market's got a very high probability of reversing. Not it's going to reverse, not I'm going to bet the kitchen sink on it, but there's a high probability it's going to reverse. 6 times out of 10, 7 times out of 10. Do I execute then over here? No. Why? Am I just going to go provide liquidity to this market? It can keep going lower. It's going lower for a reason, which is that it's not finding liquidity. So what do I do in order to take a trade? I wait for liquidity. Do we have a strategy? Yes. When liquidity comes in, what do? We buy it. Where do we stop at? Below the liquidity. What do we target? We target that point where someone else provides liquidity. Why? Not because I say so. Because if you get enough examples, that's what it does. It will go back, bid, and rotate until it finds someone providing liquidity. Again, you're getting this idea where we move away from this concept of I must buy because there's support, and we move into this concept I buy when someone else shows me it's time to buy. I don't provide liquidity, I let someone else provide the liquidity and I just hop on. Okay, that's strong auctions. Let's move on to the next weak auction. Okay, there's just an example of it. Now again, weak auction doesn't necessarily mean low volume, and we're going to talk, I know one of you is going to ask me this question because it's the one question I get asked the most. What's the difference between absorption and consolidation? How do I know the difference between absorption and consolidation? We'll get to that point, okay? But a weak auction is simply where price is not moving anywhere. Now price might not move anywhere on low volume or high volume, okay? And that's the difference between absorption and consolidation. They're both weak auctions, but absorption is high volume. In other words, someone is purposefully absorbing and taking the market, taking and provide, well, not taking the market, providing liquidity to the market. Okay, that's the difference between absorption and consolidation. So to come back to your question of algorithms, if I was to associate one with the other, I'd say algorithms tend to partake in a consolidatory phase, whereas bigger time frame players tend to partake in a absorption phase, if I was to do it. Okay, so that's our weak auction, and we can simply associate that with the lack of price change. I'm just going to draw a line like that, no price change. Okay. Rotations. I need to get a move on, otherwise we're not going to get our cakes in. Okay, rotations, price pressure. when you look at the footprint, all right, everything comes down to how much volume, how much net interaction, and most important, how much effort are the sellers imposing on the market. Okay? More important, if I put a lot of effort in, I expect to see price respond. If price is not responding, right, what is that telling us about the nature of the market? It means someone else is actually taking the other side of the trade. And that's how you've got to look at this footprint. You always got to look at it in terms of the volume, the delta, and the price change, okay, or the effort, the net effort taken to get price to where it is. Okay, so in terms of rotations, what we're looking at is I've explained the absorption consolidation. We'll get to that a little bit later on. We want to look at something called one-time framing. Now, one-time framing is a particularly strong auction or strong trend-like move. Okay, I showed you the example in the beginning. One-time framing is simply where price pressure holds in one direction. Right? We know there's price pressure because we can see the market cannot take out a previous rotation low. Okay, it's called one-time framing. Now, one-time framing is a wonderful strategy. It's wonderful if you are in the right frame of mind to be a buyer, because it's almost like you get paid, you almost get overpaid for what you're doing. Okay, so what I mean by it, let's say for example, you like the idea of being a buyer and you saw the liquidity coming in and you bought it. Now, if you're in your right frame of mind, you wouldn't get out of this one-time framing until the market told you to get out. Okay? Now, why I say it's quite lucky is because one-time framing is incredibly powerful and it tends to push a market beyond a certain point. Okay? It pushes the market until it finds the liquidity. Now, if you're not in the right frame of mind, it gives you a trade on the other side. Right? So I'm kind of giving you, or if you like the idea of one-time framing, I'm giving you a strategy you can go and look at straight away. One-time framing will stop when it finds what? Liquidity. Okay. So when it finds liquidity, does that mean that it's going to go down? No. Okay. It just means that price is going to then turn from a strong auction to a slightly weak auction. Okay. Now it all comes down to the next move, whether it's up or down, is all dependent on two things. One, is this absorption taking place, or is it a consolidatory phase? Okay, now remember we said absorption, as a general rule of thumb, will be high volume, whereas consolidation will be low volume.
Distribution.
Okay, distribution, same thing. Okay, so that's the first thing it's dependent on. The second thing is how much liquidity is each one still or responsive. Okay, so we used the word responsive earlier. Responsive is nothing more than liquidity provision or a liquidity provider. Okay, so what it comes down to, if the sellers are willing to keep providing liquidity, eventually the buying phase will fizzle and price will start to slowly leak on down. Now the wonderful thing when you start to look at interactions time and time and time again, you'll begin to recognize that very rarely, and this is why this can be a frustrating play, very rarely will you see one-time framing hit a point and go straight down. It doesn't work like that. Okay, why? Because of the nature of markets. In other words, we've had this buying phase, weak or strong auction. It runs into liquidity. Okay, now because of this buying phase, there's a lot of positions in the market and a lot of different people being forced to do different things. And that's what creates this hive of activity, this consolidatory phase. Right? So the way the market's either going to move down or potentially move up is all dependent on liquidity, all dependent on the response at that price point. Sometimes it's going to go down, but more often than not, it's going to take a heck of a lot of time and effort up here before it starts to either continue or continue down. So straight away, all of you should be going, okay. So if I go back and I research this and I look at this and I find that 9 times out of 10, it'll end up spending half an hour in this consolidatory absorption phase. We don't know which one it is yet. But if I go and find this to be true, you should all be going, well, that means there's an opportunity. Because if I know with a high probability that suddenly markets are just going to rotate on price, well, I can then become a buyer and a seller. I can scalp the market out. Now remember what I said to you. This is not about me telling you what you need to go and do and how you need to trade. This is about me showing you different ways to skin a cat. Okay? You have to determine, are you someone who likes to scalp? If you are someone that likes to scalp, this is something you go and look at. If you're someone that wants to hold something for a bigger move, you don't go look at this because it's just going to invite problems, right? But these are easy opportunities. We're talking, you can steal 1 or 2 prices. Now again, a lot of you are going to go, but 1 or 2 prices? Hang on a sec. How are you going to make money with 1 or 2 prices? Well, take a 10 lot with 1 price and you do it 4 or 5 times in a year, and you do it over a course of 4 markets in a day, and you do it over a course of a week and a month and a year. What do you have? Whatever number you want it to be. Is that trading? What's the objective of our job? It's to make money. We don't have to be right. Someone said, what did you do today? Well, I took 4 one-tick winners in this top of this consolidation thing. It wasn't much fun, but it was stress-free, and I made 400 quid doing it. Okay. So that's effectively our absorption consolidation. That's our rotations. Now again, don't worry, I'm just going briefly over these kinds of concepts as an example of it. So straight away, let's have a look at this, just so we can see the absorption. Okay. So again, we can see the most important thing with one-time framing is that rotation. It's the price pressure. We're holding pressure to the upside. Now, the most important thing is we see that volume pick up. Now remember what I said to you. When we see volumes pick up and interaction pick up, right, that's showing us strength in the trend. Okay. Low volume ones tend to be reversed. High volumes tend to hold and potentially continue. And then all of a sudden, what do we see up here? Okay, again, if I open it up, you could see it a lot better. But suddenly, we go from buyers lifting offers to suddenly sellers start hitting into bids. Okay, there's your interaction. There's your response. The sellers step in. We can see, if you note there, it's quite small, but price was unchanged in this rotation. And that simply tells us, it's not that sellers now, it's not to tell us that's suddenly a premium price. It's just telling us now that sellers are willing to start providing liquidity there. Okay? This fancy little line just happens to be the VWAP on the day. Okay? Don't know if it's significant or not, but it's there. Okay, so that's the purpose of it. We use the one-time framing. We wait for the liquidity to be provided. Notice the dark colors again. And I will show you this a lot on the footprint today, but the dark colors are showing us that liquidity. It's showing us the two-way trade in the market. That's all liquidity is, by the way. Okay, it's a lot of trade being facilitated at prices. Someone wants to buy and someone's willing to sell at the same area of prices. That's what liquidity provision is. Okay, so that's our one-time framing. Let's now move on to 1 or 2 concepts, and then we can finish up for the session. So I've explained the opportunities of one-time framing. Just for those of you that are more traditional candlestick traders, I'll go through this. Right? But in essence, what we're looking at here is just a candlestick, okay? And I wanted to go through this concept of liquidity and volatility. I will hammer this home a lot more today. Volatility, to start off with, is simply just where the market wants to facilitate trade over a greater number of prices, okay? That is the principle. It's the truth. We don't need to discuss it. It is what it is, okay? The market wants to facilitate trade over a greater number of prices. Now, there's a number of reasons why the markets will want to facilitate trade over a greater number of prices, but the basic premise is that market makers are not willing to provide the same amount of liquidity at each price. Okay. So what that should make you recognize, and this is a mistake I hear people say all the time, they think volatility implies trend. It does not. Okay. A market can be normally distributed, but very volatile. All it means is that we're trading over a greater number of prices. Now, you need to be aware of volatility in every instance, because volatility is opportunity. It's your friend. Why? The basic nature and premise of markets. The greater number of prices we trade over, the more participants that are forced to trade. Right? If more participants are forced to trade, there's going to be more opportunities to trade. Right? So your playbook should look very different in non-volatile conditions to volatile conditions, because they're completely different conditions. Right? What I like to do is I've got it up on, I've actually got a picture of it. It used to be up on the whiteboard, but I've got a set of rules to follow in volatility. Right? Now, I tend to fade markets quite a lot, right? But when there's volatility, I have no interest in fading a market. No interest whatsoever. I turn from being technical to being flow driven. I go with the flows. Why? when the markets become volatile, and this is the basic crux of it, right? The amount of liquidity being provided tends to disappear. So it comes back to that question which I spoke to you about in the beginning. If there's less participants providing liquidity, and I go do my thumb suck, I want to buy the market here and provide liquidity, I'm just adding more risk by providing liquidity. Why? Because there's less participants providing liquidity. Not because I say so, but because we can see them providing less liquidity. Okay, so you can see how the risk parameter changes when there's volatility and when there isn't volatility. Okay, now liquidity is just simply how much trade, how much volume are buyers and sellers willing to provide at a price, over a series of prices, over a range of prices. Okay, so that's the difference between liquidity and volatility. They do sort of go hand in glove. Okay, there are some very distinct relationships you can make with volatility and liquidity, but they can also equally be reversed. So don't think necessarily that low liquidity implies high volatility. It's not always the case. Okay, you can actually see very low liquidity, like we've got at the moment. If you go and look at some of the currency markets, maybe not the pound, but some of the currency markets have got very little volatility and very little liquidity. Why? Maybe they're waiting for some more information, some fundamentals, some central bank news, who knows? Okay, so don't make hard, fast rules on liquidity volatility. Just understand what volatility is, what it implies for your approach, and the same for liquidity.
How do you measure volatility?
Okay, so very simply, two ways. And I'm going to show it you an example. Okay, we've got 1, 2, 3, 6 prices there, 6 prices there, 5 prices there, and call this 13 prices. That's how I measure volatility. Yeah, that's how you measure volatility. Okay, not because I say so, because now the market wants to facilitate trade over a greater number of prices. So your next question is going to be, how do we know it's constant volatility? Well, we need to see it sustained. How do we know that? Well, you get a daily chart up, candlestick chart, and if you see that the prior 10 days, that's the average range, and the next 10 days, that's the average range, okay, we can see the volatility is picked up. Okay. Now the next question, how do we know there's liquidity being provided? Well, it's very simple. We want to see very dark colors, dark shades in the market. We want to see high pockets of volume being traded in the market. If I was to show you low liquidity versus high liquidity, you'll see the distinct difference, but it comes down to how much volume is being provided at each price. Now again, not good to look at it on a 5-minute chart, okay, because that's just going to make a lot of noise. If you want to see liquidity and see where it's generally being provided, get a daily candlestick up, and you'll straight away see, your eyes will go, wow, okay, so all the volume is provided down here and nothing up there. More than likely, that day type will look something like that. I don't need to guess. I can tell you that's what it'll look like. Okay, why? No trade facilitated up there, no liquidity. Market's role is to facilitate trade. Where did it facilitate trade? It did it down here. Okay, so very often, if I told you that's what it should do based on the principle of liquidity, but it closed up here, what does that tell you about this market? We'd have to go think about that. Okay, and that's the important thing, guys, is that when you understand the principle of liquidity, the principle of volatility, you can then start to develop a deeper understanding. What should a market do? Okay, if I see the shift in volatility here, and I know that when there's a shift in volatility and it sustains, that price does X, Y, and Z, well, guess what? You can start to develop strategies. When price doesn't do X, Y, and Z, what can you do? You can start to develop strategies. Because if I know the probability is high that it should go down, but it doesn't go down, it's giving me the counter information, which is someone else is sitting there providing liquidity, in which case it actually can go up. But the most important thing, and this is when we get to the templating, the most important thing is you've got to start asking the right questions to start telling the right story to develop the understanding of where we should go next. Okay, so everyone happy with that? Liquidity, volatility. Volatility in footprint sense, greater number of prices over which we're trading. Now the important thing is we can see a relative shift here. Everyone happy with that? We can see the relative shift in volatility. All right. What's more important is not one-off volatility. You don't want to go look at a footprint and go, oh, there was volatility, and it died again. We want to see sustained volatility. Okay, because remember, it's the sustained volatility that drags more and more and more people in. The more volatile the market comes, the greater number of prices, the more participants that are forced to trade. More participants means more money for us. But we need the right approach to trading that volatility. Okay, let's move on. Okay, we've got to get to the cakes now. Okay, very quickly, liquidity buckets. It's exactly what the word says. It's a bucket of liquidity. Okay, Goldman Sachs doesn't go, I'm only buying at 91. They're buying at price points. They're buying at yields. They're buying one against the other. So there's liquidity being provided. Liquidity bucket. Liquidity bucket. It's a bucket of liquidity. Dark versus light. Dark versus light. Dark versus light. These are liquidity buckets. What do these liquidity buckets mean? Just means someone provided liquidity. Right? On its own, it means nothing. What did price do at that liquidity bucket? That means something. What did the volume do at that bucket? That starts to mean something. Combine the two. The relative shifts, the price change, the liquidity, the volatility, all of them together will start to give you the big picture. Okay, volatility shifts, as I said, we can see nothing really going on, and then suddenly the volatility shifts. There's a relative shift in the volatility. Right? That's all we're trying to expose there. Okay, and then, again, I'm not going to go through that. Now, important concept we need to just spend a little bit of time on. Intention versus price dynamic. These are the kind of questions you want to be asking yourself on the footprint. Okay? And there's lots of these questions, but these are very important questions. How much effort are the buyers and sellers putting in? Okay, by effort, a lot of volume coming in, a lot of selling delta, but price is not going down. How much effort am I putting in? A hell of a lot. Okay, but price is not responding. In other words, I'm not getting rewarded as a seller for selling because price is not going down. Remember, I'm selling, I need to be rewarded. Right, so that's the first question you ask. If you get the reward with price, that means A. If you don't get the effort, that means B. Both things in their own mean something. Create opportunity. How much response is coming from the other side? Okay, in other words, we might be putting in a lot of selling and no one's responding and price is just dropping, like I showed you in the strong auction with low volume. Maybe there's a lot of selling and there is someone responding, but price still keeps going down, which tells you there's a hell of a big seller here. Because why? If there's a lot of buying but selling keeps going lower and lower and lower, it means that there's a significant seller in the market. Okay? How much is price moving relative to the effort putting in? Speaks for itself. Where is the effort being put in relative to price? Very important, and I'll show you why. Sometimes we look at a footprint and we'll see right at the low of the day. So it started all the way up here, and right at the low of the day, we'll see the most negative delta on the day, and we'll see the highest volume of the day. So plus 80,000, minus 4,000, it looks like the end of the world, and price has just responded, has dropped 50 ticks, and everything comes in down at the bottom, and we go, wow, there's a lot of effort put into that low. And suddenly prices go up. You're like, that doesn't make sense. All the effort put into the low, all the selling, all the volume, but price goes the other way. Okay, what's going on here? Okay, very often when you see that, you've got stops in the market. Okay, stops have been triggered. Everyone's just packed in the towel, given up. They've thrown everything. They're like, I just want out. I just want to liquidate the risk. And the market pukes off. Right? They provide very significant opportunities. Why? Because the effort in an auction, remember what I said to you? In an auction, we sell there and we buy there. We don't start aggressively selling and doing the most amount of volume over there. Okay? The market's there to facilitate trade between the buyers and the sellers. Right? So when we get that type of price response in the footprint, it's actually very good fade. Don't worry too much about that, we'll get to that later. And then, what is the market's effort position? And I'll show you effort position a little bit later. But what that boils down to is, ultimately, as we see buying and selling in the market, one sec. Okay, as we're seeing buying and selling in the market, you're going to see a net effort, right? In other words, we start selling it, yeah, prices move down and move down and move down. It bounces, we sell it again, and it moves down and down and down. So the net effort is that the sellers are building and building. The positioning is building on the short side. We take out maybe the previous day's low, and the net effort keeps building towards the downside. Right? It's important we understand this net effort, because when the market's price starts to rise, that net effort starts to unwind. Right? One of the trade strategies you can learn about is what we call a delta reversal, or a cumulative delta reversal, or a position unwind. Okay? We've seen it in oil 3 times this week. If you're an oil trader, you'll understand how painful it is. But again, it brings us back to that concept of, trade what we see. Don't trade what you think. Don't provide the liquidity. Let someone else provide it. You get back in. Okay, let's get through this, guys. Sorry, this is running a little bit over time. Again, we'll get back to who's in control. This is a question that a lot of people ask. In essence, okay, our control is nothing more than, and I think this is a good way to explain it, our control is nothing more than the price change plus the volume plus the delta. Okay? The side that's in control is ultimately getting rewarded with price change, but they're doing it on high volume and high delta. Okay? If you want a rule of thumb, it's a principle. If you see a market price rising, but you're not seeing a response in the delta and the volume, okay, it doesn't necessarily show that prices are going to collapse, but it shows that there's not that control factor there. Why? We always want to see buyers lifting liquidity out of the market. Why? Because that means they're putting in a lot more effort to get prices up. Okay, if they're putting in more effort to get prices up, they're going to be more likely to continue prices up, but also more likely to defend those positions. Right? And that's why when I showed you that strong auction, when it's done on low volume, it's because there's low effort. It doesn't take a great deal to get the prices down, and that's why it reverses. All right, and that's why we look at the controlling of the market. All right, now I've explained the initiative price responsive. Again, I think I've gone through the relative changes. These are the relative changes you're going to look at. It is the price change, the volatility change, the volume change, the cumulative delta change. We're going to go through all of these relative changes one by one as we go through the examples. Okay? But the footprint in a nutshell, that's what you're looking for. You're looking for those changes. Those relative changes give you the signal. The signal tells you where to buy, when to buy. It also tells you where to stop out. You know all of that, you've got a trade strategy. Okay, and the last thing is triggers. And I'm going to briefly go through this. A trigger is very simple. And the best way to explain this is with the S&P. Okay, 26.21 this week. Or was it 27.21? 26.21. Was a key level. Key support was the October lows. Whole market was talking about. We get below there, it's the end of the world. Okay? It also had like a double bottom on the dailies. That's a trigger price. Why? Not because I say so, not because the market went down, but because when we took out that price in the E-mini S&P 500, the delta shifted, the interaction shifted, the volatility shifted, the volume shifted. Everything on a relative basis shifted. In other words, it triggered a response from not small players, not algos, from everyone. Everyone responded on that trigger. Okay? A trigger isn't just where price moves. It's got to be price, volume, delta, relative change, liquidity, volatility, all of them together. That's a trigger. Again, when we see triggers, we have opportunity. Okay. Now the most important question, is it sustainable? Okay, some triggers are sustainable when you have effectively a trend day. Triggers and continuation. Sometimes they're not sustainable, in which case we reverse. Okay, that is then the end of session 1. Are there any questions? I know those cakes look extremely good. Are there any questions before we wrap up? Anything that's not self-explanatory? What I will say is we're going deep into the principles now, and we're going into the examples now in session 2. So it's going to all start to piece together. The story is going to unfold. Right? What I will say as the last thing before we break, in session 3 I'm going to do some storyboarding with you. Okay, I'm going to play a scenario. I'm going to say, this is what happened. Paint a footprint picture for me. Talk to me. Write out things like liquidity, volatility. Paint the story in your head of how it should look. And then we're going to look how the market did react. Okay, cool. Thanks, guys.